The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is for the purpose of receiving the semi-annual testimony of the chair of the Board of Governors of the Federal Reserve System on the conduct of monetary policy and the state of the economy. I now recognize myself for 3 minutes for an opening statement. Last month, we all heard President Obama attempt to take an economic victory lap in his State of the Union speech, but the American people are having none of it, though. They are tired of hearing from out-of-touch ruling class in Washington just how good things are when their realities are vastly different. So, Chair Yellen, notwithstanding the fact that you are a presidential appointee, I hope you do not follow suit this morning. The reality is, since the president was elected and the Fed embarked upon its unprecedented quantitative easing and zero real interest rate policies, working families' paychecks have declined. Their net worth has declined. The real unemployment rate continues to hover around 10%. Approximately 1 in 6 is on food stamps and almost 15% live in poverty. There hasn't been a single year when economic growth has reached 3%. As one published report on this failure noted, quote, "There is no parallel for this since the end of World War II, maybe not since the beginning of the Republic," unquote. Last year's less than 1% GDP growth just punctuates the matter for struggling working families. Now, I will not use this hearing to either praise or condemn the Fed's decision to raise by 25 basis points interest rates in December. Nor do I think it appropriate to advise the FOMC on how to vote during its next meeting. But given that Article 1, Section 8 of the Constitution gives Congress the power to coin money and regulate the value thereof, I do feel compelled to demand that the Fed adopt a monetary policy course that is predictable, transparent, sustainable, and barring terribly exigent circumstances, to stick with it. This is part of the rationale underlying the House-passed Fed Oversight Reform and Modernization Act known as the FORM Act. To use Austrian economist Friedrich Hayek's phrase, it is fatal conceit to believe that the Fed is capable of micromanaging our economy to some state of economic nirvana. We now have at least 8 years of recent history to prove otherwise. Most importantly, no amount of monetary policy can substitute for sound fiscal policy, unless and until the crushing regulatory onslaught of Obamacare, Dodd-Frank, and the EPA is replaced with greater opportunity, competition, and innovation. The Fed cannot substantially help our economy. It can only hurt it. It can hurt it by continuing to serve as the financier and facilitator of our unsustainable federal debt. Just last month, the Congressional Budget Office yet again warned of our unsustainable debt in its latest baseline release, which references the debt 199 times. The Fed can hurt our economy by continuing to force investors to chase yield, thus inflating dangerous asset bubbles, the deflating of which we are likely seeing in our turbulent equity markets today. The Fed can continue to hurt our economy by failing to unwind its unprecedented balance sheet. By growing at almost 500%, the Fed itself has become one of our largest sources of systemic risk. Finally, separate and apart from monetary policy, alarmingly, the Fed under Dodd-Frank can now functionally control virtually every major corner of the financial services sector of our economy. It does so with almost no accountability or transparency. Not only does this harm economic growth, it is an affront to due process, checks and balances, and the rule of law. The American people should again be duly alarmed that they may wake up one day to discover that our central bankers have become our central planners. The chair now recognizes the ranking member for 3 minutes for an opening statement.
Thank you, Mr. Chairman, for this meeting here today, but I'd really like to thank Chair Yellen for being here with us today to discuss the state of the economy and your role in ensuring that a full recovery is achieved for all. As a result of your Herculean efforts, the efforts of Democrats in Congress and the Obama administration, we have truly made tremendous progress since the darkest days of the financial crisis. Over the past 71 consecutive months, our economy has added more than 14 million private sector jobs, and the unemployment rate has fallen by more than half. But despite this commendable progress, significant work remains. Wages have yet to see real gains. 7.8 million workers remain jobless. 6 million workers are involuntarily working part-time jobs. And another 2 million Americans indicate they would join the workforce if only the economy were strong enough to support them. With inflation consistently running below target, I wonder whether the expected path for further raising rates over the course of 2016 may overemphasize concerns about inflation and underestimate the weakness in our labor market, and I look forward to your comments on this issue. Absent a full recovery, I fear that further raising rates may be a step that takes us further away from what is needed to ensure that the needs of vulnerable populations are met. At today's hearing, I also hope we can explore the ramifications of an exit strategy that relies heavily on paying private sector banks not to lend the funds they hold in reserve, and discuss reasonable alternatives that may exist that do not involve a massive transfer of wealth from the Federal Reserve to private sector banks. I just wonder if it is possible for these funds to be used for workers who are really worried about whether or not they're going to have a pension, or if there can be some social responsibility investment with these funds to help our workers and vulnerable populations. Finally, many of us have been very patient about the implementation of the living wills. And you know, this is a requirement in the Dodd-Frank Act, and it's designed to end too big to fail. And I know that you have to give careful consideration to all of this, but after one, not two, but 5 submissions, the Federal Reserve has yet to impose consequences for living wills that are not credible. What can we do about this? It's time that we understand that we have given a lot of opportunities to the banks to get it right, and they haven't done that. Chair Yellen, I look forward to hearing your views on the economy, and I welcome the opportunity to discuss how to be more effectively we can more effectively elevate the needs of the most vulnerable populations and promote a safe and sound financial system. And I want you to know that our audience today is made up of workers who really want to hear you talk about this. So I would welcome opportunities to address some of their concerns. I yield back the balance of my time.
Chair now recognizes the gentleman from South Carolina, Mr. Mulvaney, for 2 minutes, the Vice Chair of our Monetary Policy and Trade Subcommittee.
Chair Yellen, when I sat down last night to get ready for this, it occurred to me that I could ask you about a bunch of things today. I could ask you about your plans on interest rates and how you arrived at the decisions that you're going to make, what you use to arrive at those decisions. I could ask you about your role at the Fed in regulating financial institutions. Dodd-Frank, for example, has now given you regulatory powers over banks, non-banks, clearinghouses, and thrift holding companies. It also struck me I could even ask you about the role of the Fed, and more specifically the New York branch, in the possibly misleading statements that I believe Secretary Lew made to 2 congressional committees regarding the Fed and the Treasury's role in intentionally withholding information from Congress about plans to prioritize debt payments during the last government shutdown. And then I realized that's too much. That's too much, not just to ask you in the few minutes that we're going to have today, it's just too much for you to be doing. The Fed has, like so many other parts of our government, grown way beyond its original intended scope. When Congress chartered the bank in 1913, we asked it to do one thing: keep the financial system and primarily currency stable. Today, the Fed is involved in everything from how much purchasing power these people have to where they can bank, how they can invest and save, and to believe some, whether or not they even have a job. Maybe you shouldn't be involved in trying to get us to full employment, something that your own economics orthodoxy teaches us you don't have the ability to do, but only fiscal policy can do. Maybe you shouldn't be involved with regulating mortgages and credit cards. And you certainly shouldn't be involved in political decisions to intentionally keep Congress in the dark about how this country is going to pay back its principal and its interest on the debt. So I hope today we get a chance to talk about a lot of things: sound money, the dual mandate, full employment, regulations, the debt ceiling, community banks, the impact of zero rates on retirees, asset bubbles, in hopes that at the end we discover that perhaps the time has come to get back to basics and one thing only, and that is long-term price stability.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Wisconsin, Ms. Moore, for 2 minutes, ranking member of the Monetary Policy and Trade Subcommittee.
And thank you so much, Mr. Chairman, and welcome back, Chair Yellen. Well, as you can tell from the opening statements, there's plenty to discuss since your last appearance before this committee. I supported your rate increase in December. I still do. And I think you're providing a lot of credibility to markets with your leadership. However, these seem to be economic times that are destined to be interesting. Since December, we've witnessed a lot of global economic turmoil, and now it's turning up in the U.S. as reflected in our stock market. Foreign central banks are moving to ease rates, even as we're moving to try to tighten them. And I'm not saying that we need to harmonize our monetary policy, but I'm very interested in hearing how you and the Fed are working with foreign central banks to get in front of these ominous trends. As you've stated so many times before, monetary policy is a limited tool. But if we're going to grow our economy and keep it on track, and as I look at the folk in green in the audience, it causes me to realize that members of Congress have to do their part too, and not just throw it all in the lap of the Fed. We've got to embrace proven growth strategies like tackling poverty, especially among women, by providing vocational training so that they can qualify and compete for sustainable jobs with living wages. And with that, I would yield back the balance of my time.
Gentlelady yields back. Today, we welcome the testimony of the Honorable Janet Yellen. Chair Yellen has previously testified before this committee, so I believe she needs no further introduction. Without objection, Chair Yellen, your written statement will be made part of the record. You are now recognized for 5 minutes to give an oral presentation of your testimony. Thank you.
Thank you. Chairman Hensarling, Ranking Member Waters, and other members of the committee, I'm pleased to present the Federal Reserve's semi-annual monetary policy report to the Congress. In my remarks today, I will discuss the current economic situation and outlook before turning to monetary policy. Since my appearance before this committee last July, the economy has made further progress toward the Federal Reserve's objective of maximum employment. And while inflation is expected to remain low in the near term, in part because of further declines in energy prices, the Federal Open Market Committee expects that inflation will rise to its 2% objective over the medium term. In the labor market, the number of payroll jobs rose 2.7 million in 2015 and posted a further gain of 150,000 in January of this year. The cumulative increase in employment since its trough in early 2010 is now more than 13 million jobs. Meanwhile, the unemployment rate fell to 4.9% in January, 0.8 of a percentage point below its level a year ago and in line with the median of FOMC participants' most recent estimates of its longer-run normal level. Other measures of labor market conditions have also shown solid improvement, with noticeable declines over the past year in the number of individuals who want and are available to work, but have not actively searched recently, and in the number of people who are working part-time, but would rather work full-time. However, these measures remain above the level seen prior to the recession, suggesting that some slack in labor markets remains. Thus, while labor market conditions have improved substantially, there's still room for further sustainable improvement. The strong gains in the job market last year were accompanied by a continued moderate expansion in economic activity. U.S. real gross domestic product is estimated to have increased about 1.75% in 2015. Over the course of the year, subdued foreign growth and the appreciation of the dollar restrained net exports. In the fourth quarter of last year, growth in the gross domestic product is reported to have slowed more sharply, to an annual rate of just 0.75%. Again, growth was held back by weak net exports as well as by a negative contribution from inventory investment. Although private domestic final demand appears to have slowed somewhat in the fourth quarter, it has continued to advance. Household spending has been supported by steady job gains and solid growth in real disposable income, aided in part by the declines in oil prices. One area of particular strength has been purchases of cars and light trucks. Sales of these vehicles in 2015 reached their highest level ever. In the drilling and mining sector, lower oil prices have caused companies to slash jobs and sharply cut capital outlays. But in most other sectors, business investment rose over the second half of last year, and home building activity has continued to move up on balance, although the level of new construction remains well below the longer-run levels implied by demographic trends. Financial conditions in the United States have recently become less supportive of growth, with declines in broad measures of equity prices, higher borrowing rates for riskier borrowers, and a further appreciation of the dollar. These developments, if they prove persistent, could weigh on the outlook for economic activity in the labor market, although declines in longer-term interest rates and oil prices provide some offset. Still, ongoing employment gains and faster wage growth should support the growth of real incomes and therefore consumer spending. And global economic growth should pick up over time, supported by highly accommodative monetary policies abroad. Against this backdrop, the committee expects that with gradual adjustments in the stance of monetary policy, economic activity will expand at a moderate pace in coming years, and that labor market indicators will continue to strengthen. As is always the case, the economic outlook is uncertain. Foreign economic developments in particular pose risks to U.S. economic growth. Most notably, although recent economic indicators do not suggest a sharp slowdown in Chinese growth, declines in the foreign exchange value of the renminbi have intensified uncertainty about China's exchange rate policy and the prospects for its economy. This uncertainty led to increased volatility in global financial markets, and against the backdrop of persistent weakness abroad, exacerbated concerns about the outlook for global growth. These growth concerns, along with strong supply conditions and high inventories, contributed to the recent fall in the prices of oil and other commodities. In turn, low commodity prices could trigger financial stresses in commodity exporting economies, particularly in vulnerable emerging market economies and for commodity producing firms in many countries. Should any of these downside risks materialize, foreign activity and demand for U.S. exports could weaken and financial market conditions could tighten further. Of course, economic growth could also exceed our projections for a number of reasons, including the possibility that low oil prices will boost U.S. economic growth more than we expect. At present, the committee is closely monitoring global economic and financial developments, as well as assessing their implications for the labor market and inflation and the balance of risk to the outlook. As I noted earlier, inflation continues to run below the committee's 2% objective. Overall consumer prices, as measured by the price index for personal consumption expenditures, increased just 0.5% over the 12 months of 2015. To a large extent, the low average pace of inflation last year can be traced to the earlier steep declines in oil prices and in the prices of other imported goods. And given the recent further declines in the prices of oil and other commodities, as well as the further appreciation of the dollar, the committee expects inflation to remain low in the near term. However, once oil and import prices stop falling, the downward pressure on domestic inflation from those sources should wane. And as the labor market strengthens further, inflation is expected to rise gradually to 2% over the medium term. In light of the current shortfall of inflation from 2%, the committee is carefully monitoring actual and expected progress toward its inflation goal. Of course, inflation expectations play an important role in the inflation process, and the committee's confidence in the inflation outlook depends importantly on the degree to which longer-run inflation expectations remain anchored. It is worth noting in this regard that market-based measures of inflation compensation have moved down to historically low levels. Our analysis suggests that changes in risk and liquidity premiums over the past year and a half contributed significantly to these declines. Some survey measures of longer-run inflation expectations are also at the low end of their recent ranges. Overall, however, they have been reasonably stable. Turning to monetary policy, the FOMC conducts policy to promote maximum employment and price stability as required by our statutory mandate from the Congress. Last March, the committee stated that it would be appropriate to raise the target range for the federal funds rate when it had seen further improvement in the labor market and was reasonably confident that inflation would move back to its 2% objective over the medium term. In December, the committee judged that these two criteria had been satisfied and decided to raise the target range for the federal funds rate 1/4 percentage point to between 1/4 and 1/2%. This increase marked the end of a 7-year period during which the federal funds rate was held near zero. The committee did not adjust the target range in January. The decision in December to raise the federal funds rate reflected the committee's assessment that even after a modest reduction in policy accommodation, economic activity would continue to expand at a moderate pace, and labor market indicators would continue to strengthen. Although inflation was running below the committee's longer-run objective, the FOMC judged that much of the softness in inflation was attributable to transitory factors that are likely to abate over time, and that diminishing slack in labor and product markets would help move inflation toward 2%. In addition, the committee recognized that it takes time for monetary policy actions to affect economic conditions. If the FOMC delayed the start of policy normalization for too long, it might have to tighten policy relatively abruptly in the future to keep the economy from overheating and inflation from significantly overshooting its objective. Such an abrupt tightening could increase the risk of pushing the economy into recession. It's important to note that even after this increase, the stance of monetary policy remains accommodative. The FOMC anticipates that economic conditions will evolve in a manner that will warrant only gradual increases in the federal funds rate. In addition, the committee expects that the federal funds rate is likely to remain for some time below the levels that are expected to prevail in the longer run. This expectation is consistent with the view that the neutral nominal federal funds rate, defined as the value of the federal funds rate that would be neither expansionary nor contractionary if the economy was operating near potential, is currently low by historical standards and is likely to rise only gradually over time. The low level of the neutral federal funds rate may be partly attributable to a range of persistent economic headwinds, such as limited access to credit for some borrowers, weak growth abroad, and a significant appreciation of the dollar that have weighed on aggregate demand. Of course, monetary policy is by no means on a preset course. The actual path of the federal funds rate will depend on what incoming data tell us about the economic outlook, and we will regularly reassess what level of the federal funds rate is consistent with achieving and maintaining maximum employment and 2% inflation. In doing so, we will take into account a wide range of information, including measures of labor market conditions, indicators of inflation pressures and inflation expectations, and readings on financial and international developments. In particular, stronger growth or a more rapid increase in inflation than the committee currently anticipates would suggest that the neutral federal funds rate was rising more quickly than expected, making it appropriate to raise the federal funds rate more quickly as well. Conversely, if the economy were to disappoint, a lower path of the federal funds rate would be appropriate. We are committed to our dual objectives, and we will adjust policy as appropriate to foster financial conditions consistent with their attainment over time. Consistent with its previous communications, the Federal Reserve used interest on excess reserves and overnight reverse repurchase operations to move the federal funds rate into the new target range. The adjustment to the IOER rate has been particularly important in raising the federal funds rate and short-term interest rates more generally in an environment of abundant bank reserves. Meanwhile, overnight RRP operations complement the IOER rate by establishing a soft floor on money market interest rates. The IOER rate and the overnight RRP operations allowed the FOMC to control the federal funds rate effectively without having to first shrink its balance sheet by selling a large part of its holdings of longer-term securities. The committee judged that removing monetary policy accommodation by the traditional approach of raising short-term interest rates is preferable to selling longer-term assets because such sales could be difficult to calibrate and could generate unexpected financial market reactions. The committee is continuing its policy of reinvesting proceeds from maturing Treasury securities and principal payments from agency debt and mortgage-backed securities. As highlighted in the December statement, the FOMC anticipates continuing this policy until normalization of the level of the federal funds rate is well underway. Maintaining our sizable holdings of longer-term securities should help maintain accommodative financial conditions and reduce the risk that we might need to return the federal funds rate target to the effective lower bound in response to future adverse shocks. Thank you. I will be pleased to take your questions.
Chair now recognizes himself for 5 minutes for questions. Chair Yellen, I know you are familiar with the Federal Oversight Reform and Modernization Act, known as the FORM Act, which was passed by the House in November. It is designed to bring about greater transparency and accountability at the Fed, respect the Fed's independence, but to ensure that the Fed lets the rest of us know the variables that are used in monetary policy and their reaction functions so that working families can plan out their family economies. I know that you are not a fan of the FORM Act because I have a letter dated November 16th that you sent to the Speaker. In that letter, you call the act a grave mistake. I have another letter that describes it as an important reform. Your letter mentions or complains that monetary policy would be forced to be strictly adhered to by the prescriptions of a simple rule. My letter says the legislation does not chain the Fed to any rule, and certainly not a mechanical rule. Your letter says that the act would undermine the independence of the Fed. My letter says in no way would the legislation compromise the Fed's independence. On the contrary, publicly reporting a strategy helps prevent policymakers from bending under pressure and sacrificing independence. Your letter states that the FORM Act would, quote, severely damage the U.S. economy were it to become law. My letter says the new legislation would improve economic performance. By definition, your letter is signed by you. My letter is signed by Dr. Lars Hansen of the University of Chicago, Nobel laureate in economics. It's also signed by Robert Lucas, University of Chicago, Nobel laureate in economics. Edward Prescott, Arizona State University, Nobel laureate in economics. George Shultz, former Secretary of the Treasury. Robert Heller, former Federal Reserve Governor. Jerry Jordan, former president of the Cleveland Federal Reserve Bank. William Poole, former president of the St. Louis Federal Reserve Bank, former member of the Council of Economic Advisors. Michael Boskin, Stanford University, former chairman of the President's Council of Economic Advisors. Charles Calamaris, Columbia University, former consultant, Federal Reserve Board of Governors. Marvin Goodfriend, Carnegie Mellon, former research director for the Federal Reserve Board of Richmond. Alan Metzer, Carnegie Mellon, and John Taylor of Stanford University, former Undersecretary of the Treasury, member of the Council of Economic Advisors, author of the Taylor Rule, and there's about 15 others signatories to the letter. So, Chair Yellen, we have 3 Nobel Prize winners in economics, a host of former Federal Reserve officials, some of the most renowned and respected economists in the country pretty much disagree with everything that you asserted in your 3-page missive against the FORM Act. I know you're not a fan, but I would just caution you, Chair, that when you use such apocalyptic and hyperbolic language, you might consider whether or not this undercuts your credibility as Fed Chair. I have one question. In your testimony, Chair Yellen, in characterizing the Fed's strategy to increase policy rates, you testified, quote, removing monetary policy accommodation by the traditional approach is preferable to shrinking the Fed's balance sheet, which now holds almost as much in treasuries as China and Japan do combined. I'm trying to figure out what precisely is traditional about this current approach where the Fed, and the ranking member, I think, brought this up in her opening statement, subsidizes deposit rates for some of the biggest banks in our country, which can distort, as you well know, real asset allocation and constrain economic opportunity. And last I looked, as we speak, the Fed's fund rate is just above 30 basis points. You're paying banks 50 basis points for excess reserves, which would seem to be above the market rate. You have previously testified that this does not involve a subsidy to the banks. It appears to be a subsidy, and it appears to distort real asset allocation. So what is traditional about this approach?
The tool that we have used to raise our target for short-term interest rates, namely our key tool being interest on excess reserves, is widely used by central banks as a key tool of monetary policy. And it is the critical tool that we need to rely on in order to adjust the level of short-term rates to what we regard as the appropriate stance to achieve congressionally mandated goals. I would point out that although we are paying interest to banks on reserves, those reserves are financing our holdings, a large portfolio of holdings of longer-term Treasury securities and mortgage-backed securities on which we earn substantially greater interest. And because of that large balance sheet, this past year, the Fed transferred back to the Treasury and to the American taxpayers $100 billion.
But it is true, Chair Yellen, is it not, that you're paying 50 basis points when the Fed funds rate is 30 basis points?
It's necessary for us to raise benchmark rates in order for a whole host
That would seem to
of
imply a
short-term
subsidy
interest
to the
rates
largest
rise.
banks. My time has long since expired. The chair now recognizes the ranking member for 5 minutes.
Mr. Chairman, Chair Yellen, continuing on the discussion that was just initiated by the chairman, as you continue to embark on the path of raising rates, I want to explore the alternative approaches that may exist for the Federal Reserve to do so in a manner that does not rely so heavily on paying massive sums to private sector banks to hold on to the reserves they maintain at the Fed. While the Fed paid close to $7 billion on reserves in 2015, as the economy strengthens and rates are further increased, the amounts paid could increase dramatically into the tens of billions of dollars. Can you expand on why you believe that paying interest on excess reserves is particularly important for raising rates in the current environment, and discuss possible alternative approaches that may exist? And if you talk about what you believe is to be the mandate of Congress and how you don't have the authority for alternatives, I want to hear more about that and what you do have the authority to do.
Well, prior to the financial crisis, the Fed adjusted the level of short-term interest rates through small variations in the supply of reserves to the banking system. Following the financial crisis, as our balance sheet expanded, reserves became abundant, and the traditional old-fashioned approach was no longer feasible. Congress had debated the wisdom of giving us the tool of paying interest on reserves for many years, and decided to do so in 2006, and then speeded up implementation in 2008. The knowledge that we had that tool and would be able to use it when we deemed it appropriate to begin to raise the short-term level of interest rates, as we did in December, the knowledge that that tool was available, as I just mentioned, a tool that is critical to our control of short-term rates and widely used globally, that was an important fact when we considered all the actions that we took, the unconventional actions that we took to produce the decline in the unemployment rate and improvement in the labor market that we've achieved. So if we were denied that tool, at the present time, we would not be able to easily raise the level of short-term rates.
However, if I may interrupt you for a moment, are you saying that you're limited only to that action, or do you have the authority to make some other decisions relative to what the interest that you're paying to these big banks? You have some flexibility here?
So we would likely to regain effective control of short-term interest rates, need to shrink our portfolio from its current large level back to the kinds of levels we had before the crisis. And we have set out over several years a plan for how we would normalize policy that relies not on selling long-term assets, but on adjusting short-term interest rates. I believe that if we were to follow the plan of selling off long-term assets, it could prove very disruptive to the expansion. It's a strategy that I think could harm the economic recovery, and it certainly is not what we have set out to the public. We said we would shrink our balance sheet in a gradual and predictable way.
So
would not
if I
be
may interrupt you
disruptive.
again, you're saying that it was Congress, starting in 2006, who helped to design this approach, and Congress could, if it decided to take it away, as an approach that you would use, even though you do not think it would be helpful?
I think it would be very disruptive to the economy, and I want to point out several things about this. First of all, although the banks are earning this interest on the reserves that they hold, as the level of short-term rates rises, first of all, on their wholesale funding that many of these banks rely on, they're also paying more to gain that funding. Eventually, this will be the mechanism that would lead as well to higher deposit rates to reward savers. And finally, I really want to emphasize that from the taxpayer's point of view, the Federal Reserve has transferred since 2008 through 2015 roughly $600 billion back to Congress, to the taxpayers, to the Treasury. Funds that have contributed importantly to financing the government, and that has only been possible because we have a larger stock of reserves in the banking system and correspondingly hold a far larger stock of interest-bearing assets that pay a larger amount. Prior to the crisis, a typical level of transfers from the Fed to the Treasury was in the order of $20 billion. For the past 2 years, we've transferred $100 billion a year.
Thank you very much. We need to talk about this some more. I yield back the balance of my time.
Chair now recognizes the gentleman from South Carolina, Mr. Mulvaney, Vice Chair of the Monetary and Policy Trade Subcommittee.
I thank the chairman. And a quick follow-up, Chairwoman Yellen, on the chairman's question. You mentioned that using the IOER and the RRP were traditional tools, and then you mentioned that other central banks have used them before. Have you ever used them?
No.
And has the federal funds rate, which I understand now is trading on the market at about 30 basis points, ever been below the IOER, which is now set at 50 basis points?
Has it ever been below?
Yes, ma'am.
It's since we set when we were first given the power to pay interest on reserves, we set it at 25 basis points, and the Fed funds rate traded below it. And when we raised it to 50, the Fed funds rate moved up by roughly 25 basis points, the amount of the increase in IOER, but continues to trade below it.
All right, so your testimony is that those are traditional tools. So let's move then to a different discussion with that as a background. You have in the past been a proponent, though a reserved proponent of a rules-based system. Back in 2012, you gave a speech where you said, quote, "Why shouldn't the FOMC adopt such a rule against a as a guidepost? The answer is that times are by no means normal now, and the simple rules that perform well under ordinary circumstances just won't perform well." 2 years ago to this committee, you said something similar. You said that in response to a question about rules, you said the conditions facing the economy are extremely unusual. I've tried to argue and believe strongly that while a Taylor rule is, or something like it, provides a sensible approach in more normal times, like the great moderations under current situations, it's not appropriate. So, that's your testimony in 2014. You gave a speech in 2012. Here we are in 2016. You, by your own testimony, are using traditional tools of monetary policy. Your written testimony begins by saying that the economy's made further progress towards the Federal Reserve's objective of maximum employment. You go on to say that inflation is low in the near term, but it will rise to its 2% objective over the medium term. Are we in normal times?
The economy is in many ways close to normal in the sense that the unemployment rate has declined to levels that most of my colleagues believe are consistent with full employment in the longer run. And inflation, while it's below 2%, I do think there's a good reason to think it will move up over time. And in that sense, things are normal. But what is not normal is that the so-called neutral level of the federal funds rate that I referred to in my testimony and we discuss in the report is by no means normal. In other words, we have needed for 7 years to hold the federal funds rate, and both in nominal and inflation or real terms, inflation adjusted or real terms, at exceptionally low levels to achieve growth averaging 2% or a little bit
I
above.
understand. I'm sorry to interrupt, but I do
And
want
in
to get...
that sense, it is not normal. The economy is being held back by headwinds. I would point out that a tenet of the Taylor rule is that it assumes and embodies in it an assumption that the equilibrium level of the Fed funds rate with the 2% objective is 4%, or that the real equilibrium Fed funds rate is 2%. And
Madam
that
Chair-
simply isn't the case.
Madam Chair, I'm not actually, surprisingly, not pushing the Taylor rule. I'm simply asking about a general rule-based system because you have shown some support for it in the past. And I guess my question is this. What does the world have to look like? Because I think, admittedly, employment is better. Inflation, it seems to be under control. Yes, you say that the Fed funds rate is extraordinarily low, which it is, but that's something under your control. What does the world have to look like in order for the Federal Reserve to start considering transitioning to a rule-based system?
Well, I think the benefit of a rule-based system is it's systematic and understandable. And the Federal Reserve has attempted to engage in a systematic policy that takes a different
But what does the world
form.
have to look like? When you come back next year, what should the world look like for you to be saying, you know what, we're considering a rules-based system? What has to change?
The committee thinks that looks at guidelines from rules as useful benchmarks as it considers the appropriate stance of policy. But I believe, and I think most of my colleagues would agree, that we shouldn't mechanically follow that rule or any other rule, but that we need to take into account a large set of indicators of how the economy is performing.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Wisconsin, Ms. Moore, ranking member of the Monetary Policy and Trade Subcommittee.
Thank you so much, Mr. Chairman. And again, welcome, Chair Yellen. I want to take us in a little different direction many of us here on both sides of the aisle are really concerned about what's happening with our smaller banks. And we understand that because of Basel III, and we had a lot of concerns when we debated Dodd-Frank, and including provisions like Volcker and FSOC. And they were driven by the concerns of the large banks in active capital markets. And I know that you're not the only, the Fed is not the only regulator overseeing implementation of Dodd-Frank. But I'd like your thoughts on how the rules may have been tailored or should have been tailored for small and community banks. You know, the stress tests, the capital standards are killing our small banks, compliance, officers where they don't have the additional staff. Just your thoughts on what should have been done or how has it been tailored?
Well, let me say that I think community banks and their vitality is exceptionally important. They provide enormous benefits to the country and to the economy. I recognize that the burden on community banks is intense.
They're shutting down.
Regulatory burden. For our part, we're focused on doing everything that we conceivably can to minimize and reduce the burden on these banking organizations. We've been conducting an AGRIPA review to identify potential burdens that our regulations impose on these banks, and we will do everything that we can to respond to the concerns that are identified there to reduce burden. We're looking for many ways. First of all, we have tried to tailor our regulations to the size and complexity of institutions. The smaller community banks are not subject to stress testing requirements. Many aspects of Basel III, capital requirements and liquidity rules do not apply to those banking organizations. We've tried to simplify those requirements. We're, in addition to that, trying to reduce the duration of the time that we spend reviewing banks during exams. We're trying to simplify and be more targeted in our requests for documentation. We try to identify for community bankers what is relevant to them and what they can safely ignore. And we're looking for ways to conduct exams that are more focused on the actual risks that are relevant to a particular organization. So I recognize that the burdens on those banks have been very intense, and pledge that we are doing and will continue to do all we can to reduce burdens on them.
Thank you, Madam Chair. You know, on this committee, we spend a lot of time talking about moral hazard. So I guess I would like your view on whether or not you think there's any moral hazard on not a single person involved in the 2008 crash having gone to jail. They get fines, they get sort of compliance letters where they can clean up their act and avoid prosecution. And I'm wondering if you think that it's important for us to seek, you know, so what? You pay a fine, that doesn't stop anyone from doing the next crime, unlike other of our criminal laws.
Well, I agree with you. I do not think that individuals who are guilty of wrongdoing should escape paying appropriate penalties. For our own part, we are not allowed, obviously, to put in place criminal penalties. That's a matter for the Department of Justice. For our part, we can, when we find individuals to be responsible for wrongdoing, make sure that they are not allowed to work at the banking organizations where they committed misdeeds. And in many cases, we can make sure that they're banned from the business of banking. And when we've been able to identify individuals who are responsible, we have put in place those sanctions and will continue to do so. And we always cooperate with the Department of Justice in their investigations.
Time of the gentlelady has expired. The chair now recognizes the gentleman from North Carolina, Mr. McHenry, Vice Chair of the full committee.
Thank you, Chair Yellen. So does the Federal Reserve have the legal authority to implement negative rates?
I'm sorry, do we have the legal authority to?
Implement negative rates.
So this is a matter that the Federal Open Market Committee considered around 2010, and we didn't fully, as we were exploring our options to provide accommodation, we decided not to lower interest rates, either IOER to zero or into negative territory. And we didn't fully look at the legal issues around that. I would say that remains a question that we still would need to investigate more thoroughly.
In one of our document requests, that 2010 memo that I assume was connected to that policy discussion.
That's right.
Raised significant doubts about the Fed's authority that they currently have to charge, to pay interest on excess reserves.
So,
and whether or not that same authority would allow you to demand payment for that.
So, Congressman, I don't know of any restriction that would prevent us from doing that. What that memo indicated was intended to indicate that the legal issues had not been seriously considered.
Have they been
the time
seriously
that went to the FOMC.
Have they been seriously considered since 2010?
Well, in the spirit of prudent planning, we always try to look at what options we would have available to us, either if we need to tighten policy more rapidly than we expect, or the opposite, to loosen policy. We would take a look at it, but the legal issues, I'm not prepared to tell you, have been thoroughly examined at this point.
So at this point, it's unclear whether or not the Fed does have legal authority to implement negative rates.
I am not aware of any anything that would prevent us from doing it, but I'm saying that we have not fully investigated the legal issues. That still needs to be done.
So let's move to regulation, right? A significant part, you run the largest regulatory organization in the United States of America, perhaps in the globe, likely in the globe. And as such, I believe in the independence of the Fed to make monetary policy, but as a regulator, Congress should have significant oversight of your regulatory action, should they not?
Yes.
Okay. And as such, as a matter of regulation, the chairman raised this question with you the last time you were here about Federal Reserve regulators, bank examiners demanding to be a part of board of director meetings at member banks. And you've exchanged multiple letters on this matter. We still hear that this is in fact taking place. Would you pledge to this committee that you would direct your bank examiners and regional bank examiners to stop this practice?
Well, I will look into.
Well, you've already looked into it, and you've exchanged letters, and you gave the chairman assurance last time you were not aware of it. I assume you're now aware of whether or not this is taking place. Are you not?
I think there are occasional situations in which that occurs.
Do you believe that's appropriate?
I'm not certain that it is inappropriate. I want to get back to you on that.
Okay, well, this was raised about 6 months ago by the chairman.
that.
You've exchanged multiple letters. I'd like to have some greater assurance. So this is not meant to be a gotcha. This is a well-worn question. And we're hearing, and in fact, there's a press report that the Fed directed one of your member banks to incorporate 2 additional members of their board of directors. And the Fed directing a private enterprise to change their board of directors seems somewhat perplexing. Do you believe that's appropriate authority for the Fed?
Well, I think it is appropriate as a matter of supervision to
direct,
ensure that a board of directors of a financial company that we supervise is appropriately constituted and fulfilling its corporate governance functions. That is a part of supervision.
My time has expired.
Time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Maloney, ranking member of our Capital Markets Subcommittee.
Chair Yellen, you raised interest rates in December and said that any future interest rate increases, if they happened, would be gradual. I'd like to ask you about the recent turmoil in global markets. As you know, equity markets around the world, led by China, have plunged since the beginning of the year as global economic growth has weakened. And the U.S. has not been immune. U.S. stock markets have fallen over 9% since the beginning of the year, and Treasury yields have plunged 23%. So my question is, has the turmoil in global markets changed your view about the appropriate pace of interest rate increases and hikes, or will you wait to see how global market turmoil affects the U.S. economy before raising rates again?
We are watching very carefully what's happening in global financial markets. It would appear that the stresses that we have seen since the turn of the year relate to uncertainties regarding Chinese exchange rate policy. There are uncertainties around the price of oil. We have not seen shifts in that seems significant enough to have driven the sharp moves we've seen in markets. There would seem to be increased fears of recession risk that is resulting in rises in risk premia. We have not yet seen a sharp drop-off in growth, either globally or the United States, but we certainly recognize that global market developments bear close watching. As I mentioned, that financial conditions have become less supportive to growth, and we recognize that these developments may have implications for the outlook, which we are in the process of assessing. And I want to make clear that monetary policy is not on a preset course, and so our evaluation of the likely impact of those developments on the economic outlook and our ability to meet both our employment and inflation objectives, those are the factors that will govern the future stance of monetary policy. It's not on a preset course.
And given the turmoil in global markets and the slowing U.S. economy, some analysts are now talking about the U.S. possibly falling into a recession this year. What would it take for you to consider cutting interest rates again? A severe downturn in the economy or just stubbornly low inflation?
Well, our commitment is to achieve our congressionally mandated goals of maximum employment and price stability. I do not expect that the FOMC is going to be soon in a situation where it's necessary to cut rates. Let's remember that the labor market is continuing to perform well, to improve. I continue to think that many of the factors holding down inflation are transitory. So while there is always some risk of a recession, and I recognize and have just stated that global financial developments could produce a slowing in the economy, I think we want to be careful not to jump to a premature conclusion about what is in store for the U.S. economy. So I don't think it's going to be necessary to cut rates, but that said, monetary policy, as I said, is not on a preset course, and if it turned out that that would be necessary, obviously the FOMC would do what is needed to achieve the goals that Congress has assigned to us.
You said in December that you were surprised by how far oil prices had fallen and that you expected inflation to increase once oil prices stabilized. Since the Fed's December meeting, oil prices have fallen even further. They're down about 25% since the December meeting, and they've fallen 7% since Friday. At the same time, we've also seen inflation expectations fall since the December meeting to the lowest levels in quite some time. Has this caused you to rethink your inflation projections at all?
Well, we indicated in our statement in January that these developments led us to conclude that inflation will stay low for a while longer as these developments work through. Clearly, we are watching inflation expectations, and as I mentioned, market-based measures of inflation compensation have moved down now to historically low levels, and that is something we're evaluating carefully. In December, when we raised rates, we indicated that with inflation so far below our objective, we would carefully watch incoming data and revise our expectations. So I don't want to jump to a premature conclusion. My colleagues and I will issue in March updated projections for inflation, taking all the evidence we have at hand into account. But
The
clearly
time
that
of
is
the gentlelady has expired. The chair now recognizes the gentleman from New Jersey, Mr. Garrett, chairman of the Capital Markets Subcommittee.
I thank the chair. Chair Yellen, thank you for being here. I'd like to talk a little bit, begin on emergency lending under 13.3. So it was about a year and a half ago, Senator Elizabeth Warren and myself and Mr. Capuano joined together, and Senator Vitter as well, and sent you a letter expressing our deep concern with what you were doing with regard to implementing the limiting language in Dodd-Frank at that time. And of course, you have come out now with a rule, despite our admonition in questions in that letter, a rule that would basically allow the Fed to drive a Mack truck through the various loopholes in it, and also, once again, as is typical with the Fed, lacking in clarity and transparency. That being said, the Fed is not always not clear in what they want to do, and the regulators are not always clear in what they want to do. For example, came up with the Volcker Rule, and in the Volcker Rule, the Fed was not shy about elaborating on concepts in that statute. In fact, it went so far as to adopt prohibitions in trading assets that were clearly never intended by the statute. So the Fed and other regulators came up with this, the part of the Volcker Rule, just dealing with defining just what the words proprietary trading is, over 800 pages to make some definitional clarity in the area of Volcker and proprietary trading. Compare that to what you did with, under the limitations that should be in place under Dodd-Frank of 13.3, 47 pages of definition and lack of clarity throughout it. So the first question is why in one area can you be exact and precise and precision when you're trying to limit what the private market is doing, but when Congress tells you to put limitations on yourself, you lack that clarity and just give it a broad brush?
Well, I think we tried in the rule to be as clear as we possibly could.
Well, let's take a look at that then.
For example,
well, now let me give you an example. The Fed claims in its final that it establishes a penalty rate under 13.3, but then you failed to provide any specifics whatsoever what that rate would be. Compare that to what Congress did. This committee passed a bill that would establish a penalty rate that would be commensurate with, quote, a distressed borrower. So why wouldn't the Fed be clear on this? What is, what are the rates going to be?
Because what a penalty rate is depends on the specifics of a particular situation. A penalty rate is a rate that, when conditions normalize,
but we know what a distressed borrower is and the markets are. That's clear. Why didn't you define it that way, compare it to the regular markets, so that a distressed borrower in the markets will be charged the same if they're borrowing from the Fed or related to it?
Well, in the type of situation that we found ourselves in during the financial crisis, market rates had shot up to extraordinary levels because liquidity had dried up in the financial
I understand what the
system.
history of the market was at that time, but you could have provided clarity in here. So basically what you're telling us is, once again, the Fed is going to be in the position of picking winners and losers. By your prior answer, it seems like you're saying that you could charge borrower A one rate and borrower B another rate under similarly situated circumstances. Is that not correct?
Well, I think what is an appropriate rate does depend on the circumstances. Financial crises, which is when we would be using this authority to set up a broad-based program, are always very unique.
Right, and I think that's basically what you're telling us, is that nothing really has changed despite the admonition and the law in Dodd-Frank to put a limitation. And it's not just me saying that, by the way. It's interesting that while you're here testifying today, Governor Fisher is also making public statements as you speak. And we just got part of his statement. And he seems to be saying exactly what you are, that you have not limited 13.3. He said, but in simple language, strengthening fire prevention regulation does not imply that the fire brigade should be disbanded. He goes on basically to say in his comments today that we're not seeing the limitations, that you're going to be able to do the similar things that you did back in, or that before you were here, that the Fed did the last time around.
Well, I want to make clear that I think our 13.3 powers and ability to lend to keep credit flowing in the economy during a financial crisis is a critical power.
So is that-
played a critical role during the
So
financial crisis.
is he wrong when he says that nothing really, as my interpretation, he says nothing has really changed, your powers are the same as they
No,
were
a lot
before?
has changed. Congress put in place a series of restrictions.
But your
that
rule
they
does not implement
intended-
those, does it?
Yes, it does. Our rule does implement those restrictions. We cannot lend to an insolvent borrower. We cannot lend to help one or more failing firms. We can only put in place broad-based programs, and we have defined pretty clearly in that rule what constitutes a broad-based program. So Congress clearly changed what the Fed can do.
But it does not say-
It also
Governor Fisher is saying we have likely reduced the probability that lender of last resort will be needed, but we have not reduced that probability to zero. So it appears that you still, in his opinion at least, some of these powers remain.
Time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Velasquez.
Thank you, Mr. Chairman. Chairman Yellen, the unemployment rate is down to under 5% for the first time in 8 years. However, I remain concerned that unemployment rates remain elevated in the Hispanic and African American communities. Does the Fed specifically take unemployment within these groups into consideration when making policy decisions surrounding the Fed fund rate?
So we track very carefully the unemployment rates and experiences of different demographic groups, and we make a very careful assessment about whether or not the economy is meeting the objective of maximum sustainable employment or not, which involves taking account of factors like are particular groups being discouraged from even participating in the labor force because of conditions. But it's important to recognize that our powers, which involve setting interest rates, affecting financial conditions, are not targeted and can't be targeted at the experience of particular groups. I think it always has been true and continues to be true that when the labor market improves, the experience of all groups does improve. I mean, roughly now, the unemployment rate in the United States is close to where it was in the fourth quarter of 2007. Now, African Americans and Hispanics at that time, back in 2007, had higher unemployment rates than the population as a whole. You know, regrettably, because of the disadvantages that these groups face in the labor market, they have historically tended to have higher unemployment rates. But as the economy has improved and unemployment has come down, the unemployment rates for those groups, for Hispanics and African Americans, has come down. They have fallen to roughly the same levels that they were in at the end of 2007, while again remaining higher. So we do look at that, but we don't have tools to target particular groups rather than others.
Do you consider 8.8% unemployment rate among African Americans today too high?
I do consider it too high, and I think there are any number of reasons for that. And I think that the reasons for it are ones that Congress should be considering broadly in designing a wide range of policies. It is something that we want to see a strong labor market. We want to see continued progress, and we will put in place policies that achieve that, but we cannot target the unemployment rate for a particular group.
I heard you. As you know, Chair, U.S. employers have created 14 million jobs during President Obama's tenure. However, the labor force participation rate remains low, and discouraged people that want to work have stopped looking. How much of the decline in the rate can be explained by the trend of flat or declining wages for many American workers?
So for the country as a whole,
Right.
an important reason that labor force participation has fallen and will continue to fall is because of the aging of the population. So that's not going to change, and the trend is downward. But it is also true that for certain subgroups in the population, for example, prime age but less educated men, the trend downward has been particularly steep. And you know, there's a lot of economic research that tries to understand why men have, their labor force participation has declined. And it wouldn't surprise me if wage trends are part of the reason for that.
Correct.
So my guess is they have played a role at discouraging labor force participation.
As wages begin to increase, do you anticipate the participation rate to increase as well?
Yes, I anticipate that wage growth will move up somewhat. And I do think that labor force participation is somewhat depressed relative to where it will be in a really full employment economy. That's why I say I think there does remain some slack in the labor market, even though the aggregate unemployment rate is at 4.9%. So
The time of the gentlelady has expired. The chair now recognizes the gentleman from Texas, Mr. Nugaba, chairman of our Financial Institutions Subcommittee.
Thank you, Mr. Chairman, and thank you, Chair Yellen, for being here as well. Part of your remarks were about the state of the economy, and I think you're trying to paint a little bit rosier picture, and maybe there is a little bit of a rosier picture, but it's not a good picture. I'm looking at some stats here. We still got 16 million of American citizens that are unemployed. In fact, the number of long-term unemployed Americans is 761,000 higher than it was at the start of the recession. We've got 94 million Americans over the age of 17 that have abandoned the job market. Real disposable income is a paltry annual rate at 1.2%. I mean, the real GDP is growing just under 2.2%. We've got more Americans living in poverty than ever before, 46.7 million people. And we've got 45 million people on SNAP. I could read more and more. I think the issue that I've been thinking about this week is that when you look at the original purpose the Fed was formed for, and then what the Fed looks like today, and I think my good friend Mr. Mulvaney pointed out to point of this, is that basically we've got the Fed that's in charge of monetary policy. Some other things have been added to that. Then we've got the Fed that's the biggest and largest regulator and regulates more assets than any other financial institution in the world. And it kind of reminds me that while y'all are working on one side of the Fed to, stabilize employment, keep inflation in check, then on the other side of the Fed, you've got this huge regulatory structure that has grown substantially and continues to issue very complicated, and some people think that you've become a micromanager of these financial institutions with the regulations. So it reminds me of that statement, we have met the enemy and it is us. Is it counterproductive that you've got a Fed working on one side to create jobs and you've got a Fed on the other side of the building that's doing things that a lot of people think that are killing jobs, micromanaging the financial markets, increasing the cost of capital, the availability of capital, which has stymied the ability of this economy to grow. And so is it self-defeating?
Well, I think we have to remember that financial crises are immensely costly to well-being, and it's important to make sure that we do everything, almost everything we can to reduce the odds of another devastating financial crisis. So we are working hard. We have worked hard in the aftermath of the crisis to make sure that we have a financial system that is safer, sounder, has more capital, higher quality capital, more liquidity, is less crisis-prone than the financial system that we had that caused this financial crisis.
Time is short. You mentioned the word liquidity, and I think a lot of people think some of the things that the Fed has done and some of the regulations that have actually reduced liquidity in a number of markets. And in fact, you and I had a conversation about the fact that y'all have shown some concern about liquidity. I wanted to see if you knew that the European Commission has initiated a review process. They said after 5 years of instituting all of these regulations and additional capital requirements and kind of this piling on of regulation and capital, more capital and regulation, and I'm not against having adequate capital, but the problem is that we seem to have an add-on game here, and the additional capital also comes with additional regulations. And so the European Commission has initiated a review process, said, you know what, time out here, let's go back and look. We know what we've asked these entities to do. We know what we've impounded them with. But the question is, how are the markets responding to this, and how basically it's a cost-benefit analysis of all of the policies that have been in place. Is the Fed thought about, hey, maybe we should stop and analyze, what we've done here and see if it's positive?
Well, we have a few things we still need to finalize to put in place the Dodd-Frank regulations that were called for, and we hope to complete that work soon, and it certainly is appropriate to evaluate how the system is working, and we do that on an ongoing basis, and I think it's, of course, appropriate to see whether or not there are ways in which we can improve or simplify regulations, and we are in the process of doing that in some very important areas.
Time of the gentleman has expired. The chair now recognizes the gentleman from California, Mr. Sherman.
Mr. Chairman, I feel like I'm at a ballroom dance on the deck of the Titanic. The faith of the American people in our government and institutions is at an all-time low. I've been sitting in this room for 20 years, and the room has the feel that it had 20 years ago, except we don't have Alan Greenspan in front of us. Government institutions work better if they listen to the American people. First, because the American people will then accept the decisions, and second, because we get better decisions. Yesterday, in a small state that is doing better than most of the country, 2/3 of the people went out in at a very, I think, a record-setting turnout with inclement weather to say that they're mad as hell, particularly at the financial institutions that this committee deals with. And 2/3 of them voted for the most angry candidate they could find. Too big to fail should be too big to exist. Madam Chairman, in response to the lady from Wisconsin, you said it was basically the Department of Justice's failure to have a single criminal prosecution of those who had robbed the banks and, more importantly, robbed the American people. And I wonder whether you can really just put that at the feet of the Department of Justice, because we've learned institutions can get so big that they are too big to fail. Your predecessor was in this room demanding that we bail them out, and God forbid you will be again if you allow these too big to fail institutions to continue to exist. And as they're too big to jail. And as you point out, you may bar somebody from the banking world. Gee whiz, in a country with more people incarcerated than any other country in the world, is it really adequate to those who steal hundreds of millions and billions to say, well, you can't go back into the banking world. So I'll ask you, as a member of FSOC, we need moral hazard to make sure that major economic decisions made by the giant banks are made correctly. They don't have a moral hazard in the sense of not being able to get capital. People are flooding them with capital at rates that are said to be up to 80 basis points less than they would pay if there wasn't a belief that we would bail them out. So the too big to fail won't be allowed to fail. As you point out, DOJ won't put anybody in jail. The solution is use your power under FSOC to break them up. Are you going to break up the too big to fail institutions? I've asked you that before. I'll ask you it again. I think I know the answer.
Well, the answer I'll give you is that we are using our powers to make sure that a systemically important institution could fail and it would not be have systemic consequences for the country. We're doing that in a whole variety of ways. First of all, we've done many things to diminish the odds that they would fail. We're trying to make them, and I think I can enumerate all the things.
Are you willing
we've done.
to call the Attorney General and say, we've got this thing handled so well that you can start criminal prosecutions because they're not too big to jail anymore?
So I said that I am in favor of going after individuals who are guilty of wrongdoing.
With such penalties as barring them from the banking system.
No,
I
what
want to
said
move
is
on.
Those are the sanctions that the Federal Reserve can impose.
I need to move on to another question. You're a governmental entity, but it's in some parts of the entity, it's one bank, one vote. It's the only part of our constitutional system that puts governmental power in the hands of one bank, one vote. Are you going to use your considerable power to oppose legislative efforts to try to make the regional bank governors appointed exclusively by the president and to try to make the regional banks subject to the Freedom of Information Act?
Congressman, I think the current structure of the Fed is something that Congress decided after a long debate and weighing of a whole variety of considerations. I would say I think it's worked pretty well, but it's certainly something.
Excuse me, Madam Chair. Are you saying that the Fed, having just lived through 2008, with people not getting raises, that this whole system has worked well?
I'm sorry, I thought you were asking about our governance.
Your governance has led to the decisions that have nearly brought this country to its knees. I yield back.
Time of the gentleman has
It is up to-
expired. The chair now recognizes the gentleman from Missouri, Mr. Luetkemeyer, chairman of our Housing and Insurance Subcommittee.
Thank you, Mr. Chairman, and welcome, Madam Chair. It's kind of interesting as you discuss all of the questions that have been asked you here with regards to your ability to micromanage the economy and as you make the decisions at the Federal Reserve to try and do something about unemployment and try and do something about the inflation rate. I look at some of these things and I'm just kind of stunned. Let's start off first with what happens if we have a downturn and you've already got $4 trillion on your balance sheet? What levers are still allowed or available to you to do something?
Well, the Fed has an array of tools.
Which are?
Well, most importantly, the path of the short-term interest rates.
Madam Chair, they're already down to almost nothing. I mean, how is lowering the rates going to help when they're almost nothing right now?
Well, one of the ways in which markets works is that they form expectations about what the likely path of the Fed funds rate will be over time. Those expectations influence longer-term rates in the market. And when the economy weakens, market participants naturally expect the Fed, in pursuing our mandate, to follow a shallower path of interest rate increases. And that shift in expectations moves longer-term rates.
Well,
I think you can see that just over the last several weeks, as I mentioned, longer-term Treasury yields have come down as market participants have become more fearful about a recession.
Are you
and
interested in, for me if you're intruding, but I've got more questions here. So are you saying that is this a good time then to sort of reduce your balance sheet? Lower interest rates, it'd be a nice time to sort of shift that, wouldn't it? Are you intending to do that?
We have indicated that we want to make sure that normalization is well underway before we begin to shrink our balance sheet. And our decision to do that reflects the fact that we feel that moving short-term rates is a more reliable and understandable and predictable way to manage the economy.
Okay.
And so we're going to wait to shrink our balance sheet until a point when short-term interest rates are somewhat higher.
So we may never get there, is what you're saying, because
Well, we'll have to
there's not much room to go down. So let's.
Well, we'll have to
So let me also go into your decision-making process here. You know, we have a labor market that continues to the labor force participation rate continues to go down, and yet we had, according to your report here, the hourly rate of employees went up. So there should be more incentive for people to work, yet they're becoming less. And you use the demographics of our country to indicate that. So I'm concerned that if you look at those numbers, that there's minimal ability of your way you explained the answer to Ms. Velasquez a while ago, of you guys to be able to manipulate this. The second thing is, I'm concerned. What other factors do you take into consideration when you look at your rates? For instance, do you look at what the Congress is proposing? Do you look at the court decisions? Because we had, there's been a big discussion about trying to stop the inversion, the ability of our country, companies to go overseas and be able to take advantage of those tax rates. So the discussion is to try and cut corporate tax rates to bring those dollars home. Do you ever think about those sorts of implications whenever you make decisions on your rates? Yesterday we had a dramatic, historic decision by the courts with regards to an EPA ruling that would have dramatically changed the way that the cost of energy in this country. Do you take those things in consideration when you make your rates? Because those are dramatic, they will have dramatic increases or significant impact on our economy.
Well, we try to take into account in making our decisions any factor that we regard as important in.
So do you have in place right now some modeling with regards to the EPA rule?
Not that I know of.
Do you have in place right now any modeling with regards to potential tax cut for bringing dollars home or for corporations?
We routinely look at the stance of fiscal policy and.
You have a model in place right now if we cut corporate tax rates that would allow you to make a decision on that issue.
If you were to decide that, our staff would attempt to evaluate.
So you don't have one in place right now, is what you just said.
Not to the best of my knowledge.
Thank you very much. I yield back.
Time of the gentleman has expired. Chair now recognizes the gentleman from New York, Mr. Meeks.
Thank you, Mr. Chairman. And welcome, Chairwoman Yellen. I don't know, some of my colleagues may not have been here 9 years ago, 8 years ago, but I got to tell you, I feel better today than when I sat here 8 or 9 years ago. I feel much better today than I did then. I can remember some of what was taking place then and the panic that was going on and the pressure that this government was under. And though we've not completely done what we need to do, because we do need to let wages grow, we do need to make sure that we create more jobs. The position that we're in today, would you agree, is much stronger than the position we were in 2007 and 2008?
Well, I believe it is. I believe we've made a lot of progress, while recognizing at the same time that there are many households that are suffering and that there are a lot work. Challenges that people face and structural
And I think it's important to acknowledge that, how far we've come. And then I would hope that we would also focus then on what else needs to be done, because we do need to make sure that, especially those individuals who were victimized by the financial crisis. For example, if you look at areas and I think Mrs. Velasquez talked about it, particularly in African American and Latino communities, they lost a great amount of wealth. Many of them lost their homes, they lost their jobs. That's where, and so they need something so that they can get back. And that's why you see this disparity that is very high right now. And so what my focus then is, we had, and I guess because of what took place in the past, in 1977, we passed the Community Reinvestment Act. Now, the Fed is in charge of CRA and can enforce it. And then today, what we find still is that individuals in communities that were deeply affected, there's no investment going in, there's no job creation there, there's no access to credit, they don't have, because of primarily the crisis. So I was wondering what can, and since the Fed oversees and can enforce CRA, what is the Fed doing in helping to implement CRA, compelling some of the large banks to make these investments in these communities, as well as into CDFIs who are focused on trying to make sure that the kind of investments are there to create jobs, to grow wages in communities that were devastated by the recession?
Well, I think CRA is extremely important in making sure that financial institutions, depository institutions, serve the needs of their communities and particularly underserved communities. We take our enforcement and evaluation of banks' CRA performance very seriously. We have a whole variety of community development activities and programs that are focused on working using our convening power and their CRA obligations to try to understand and identify what the needs are in particular communities, and to try to tell banks what works, what kind of programs are worth supporting that really seem to make a difference in terms of alleviating distress in low and moderate income communities. And
one of the things I think that's important, because I want to hold, and maybe you have the answers, is to show where the banks are making these investments in compliance with CRA, because I have found that those numbers have surely sunk. And then when I look at access to capital in these communities, you have about 70 million people now who are underbanked or unbanked in these communities. And so CRA could definitely help there. So I would love to follow up with you to find out exactly, where the enforcement, who is in fact complying and giving and who's not, because there's got to be some accountability therein. Lastly, let me just, in the few seconds I have, because the other thing that I think that's important to look at in some of these communities, because in today's world, access to credit is absolutely key and essential. And sometimes in the way people's credits are looked at, is there alternative systems? For example, you find some people, they pay their rent every day on time, and that's not to be considered when reference to credit scoring models. They, so is there other models that you're looking at with reference to how credit scores are considered that the Fed could advocate?
well, I'm not sure about credit scores. We'd be glad to get back to you on that.
Time of the gentleman has expired. The chair now recognizes the gentleman from Wisconsin, Mr. Duffy, chairman of the Oversight and Investigations Subcommittee.
Thank you, Mr. Chairman, and welcome, Chair Yellen. I want to take a trip down memory lane because I think there's some rewriting of what happened in the crisis. There's a lot of people who bought homes, and for lower income folks, that's their investment. And a lot of them lost their investment walking into the crisis, devastating families. And I know we want to look to Wall Street, and there's blame there, but I think there's a little bit of revisionist history when we say, you know what, Fannie and Freddie didn't have anything to do with the crisis. Fannie and Freddie that allowed no doc loans, no income verification, allowing folks to buy homes they couldn't afford. And in Dodd-Frank, that was passed by my friends across the aisle, Fannie and Freddie weren't touched at all. Fannie and Freddie were the ones that were allowing folks in this room to get homes that they couldn't afford and they were hurt. Didn't touch them. The regulators had wild authority and power. They failed. And instead of taking a look at the regulation and the regulators, we've re-empowered regulators. And so no wonder that big banks after Dodd-Frank haven't gotten smaller. Big banks have gotten bigger. And the small community banks that I'm sure service a lot of the folks in this room and service folks in my community, they're going away. Big problem. I just had to get that off my chest. But a lot of exciting things to chat about you with Chair Yellen. But as the chairman of the Oversight Committee, I do have some concerns about your willingness to comply with our requests. We sent a letter in the Medley investigation and our oversight of the Fed asking you for information in regard to communication. No compliance. Then we sent you a subpoena in May. You did not comply with that. We had partial compliance in October. We're now a year after my initial letter. I've asked you for excerpts of the FMOC transcripts in regard to the discussion in regard to the internal investigation on Medley. You have not provided those to me. Is your intent today now to promise that I will have those, if not this afternoon, tomorrow?
Well, Congressman, I discussed this matter with Chairman Hensarling and indicated that we have some concern
Well, why don't we
with
talk about it right now?
providing these transcripts.
Finding the transcripts?
I said with providing transcripts, given their importance in monetary policy.
So let me be
And
clear.
I received a note back from Chairman Hensarling last night, quite late, indicating your response to that, and we will consider it and get back to you.
No, I don't want you to consider it. And I think the chairman would agree with me that this is a conversation not about monetary policy. This is not market-moving stuff. This is about the investigation and the conversation of a leak inside of your organization. So this institution is entitled to those documents. Would you agree?
I will get back to you with a formal answer. I believe that we have provided you
That's not my question for you,
with
Chair
all
Yellen.
relevant information.
If I'm not entitled to it, can you give me the privilege that you're going to exert that's going to let me know why I'm not entitled to those documents?
I said that we received, well after the close of business yesterday, a letter explaining your reasoning.
Chair
and
Yellen,
I will need some time to discuss this matter with my staff before I give you a final answer.
I don't want to, listen, I sent you a letter a year ago on February 5th. I had to send you a subpoena. You knew that I'm looking for these documents. You knew I was going to ask you about this today. So if you're not going to give me the documents, exert your privilege. Tell me your legal authority why you're not going to provide this to us. If this is market moving, I would be sensitive to that. This is not monetary policy conversations. This is about the internal workings of the Fed. And I'm not asking for all the transcripts. I'm just actually asking for the excerpts specific to our investigation and oversight of the Fed. Let me ask you this. You get to oversee banks. If you make a request to a bank for information a year ago, and they say, let me review it with my board, let me talk about it, but they never comply with your request for documents or information, what would the Fed do?
I think we have complied
fully
with the requests that you've made.
I'm asking you, what would you do if you had made that kind of request to a bank that you oversee? What would you do?
We work with banks to make sure we have access to the information.
And if they
needed
didn't,
for
I can't
oversight.
imagine what the Fed would do if someone didn't comply with your request. And guess what? We're entitled to the documents. We expect to get them unless you exert a privilege, and there is no privilege that you have. So I expect they'll come over. I yield back.
Mr. Chairman,
Time of the
Mr.
gentleman.
Chairman,
Time of the gentleman is, for what purpose is the ranking member seeking
Is
recognition?
it appropriate to ask for unanimous consent for clarification on a point of information that was just given by the gentleman?
Does the lady have a parliamentary inquiry?
The inquiry could be considered parliamentary. I understand the gentleman to say that they subpoenaed the feds and did not, it was ignored. Is that what he meant?
The gentlelady is not stating a parliamentary inquiry, and as I think is the ranking member knows, the time of the chair is limited. If other members wish to pursue that in their questioning, they may pursue it in their questioning. The chair now recognizes the gentleman from Texas, Mr. Hinojosa.
Thank you, Chairman Hensarling and Ranking Member Waters, for holding this hearing today. Chairwoman Yellen, I thank you for meeting with our committee today and your steadfast leadership at the Federal Reserve. America has made great progress since the financial crisis of 2008. Our recovery includes 70 consecutive months of job growth, the longest streak in our nation's history, resulting in an astounding 14 million private sector jobs created and an unemployment rate now standing below 5%. However, we continue to feel the hangover from the financial crisis started during President George W. Bush's second term. Today, the slower than average economic growth rate is fueling anxiety and weakening confidence in our nation's economic growth prospects. Additionally, our economy appears to be sailing into strong headwinds caused by slowing growth in the developing world, stagnant growth in Europe, the dual effects of plunging oil prices, and a strong dollar negatively affecting our manufacturing and export industries. Addressing those challenges also requires to answer questions regarding the sustainability of our national debt and of the ability of Congress and the Federal Reserve to act effectively to stimulate the economy. Despite that market turmoil and economic uncertainty, however, I will note that our nation's confidence in the safety and soundness of our financial system has not been shaken. Indeed, we can attribute a much stronger and more resilient financial system in large part to the protections and improvements to the market oversight under the Dodd-Frank Act. My first question, Chairwoman Yellen, what else should our nation be doing to help us return to normal growth rates?
Well, one of the distressing aspects of the recovery we've seen, I agree with you that we've made good progress in the labor market, created a lot of jobs, and the unemployment rate's low. But the growth in the economy that's been consistent with that has been quite disappointing. So another way of saying what that implies is when output is growing at a very weak pace and you have a lot of job growth, that means that productivity growth has been very disappointing since the financial crisis. And ultimately,
Yellen,
that determines living standards.
Do you think we are dragging down the potential growth rate of our economy and doing a disservice our young men and women by saddling them with debt, just as they are setting out to become full contributing members of our workforce and economic engine?
Well, I think the debt situation that faces this country over the longer term is something that Congress certainly needs to address. While at this point, the debt to GDP ratio looks like it should be sustainable at present levels for a number of years. As the population ages, it will, as is evident from CBO projections, be on an unsustainable upward course. And this is something Congress has known about for decades, and it's important to address.
It seems to me that while Congress must do its part to raise the minimum wage, expand the Social Security safety net, and provide a more progressive tax code, what steps are you taking at the Federal Reserve to address the historic level of inequality in the United States?
Well, Congressman, the main contribution that the Fed can make to inequality, given that we don't have policies that target particular groups in the labor force, the main contribution we can make is to make sure that the labor market is performing well, that we attain Congress's maximum employment objective. I'm pleased with the progress we have made, but there's further to go, and we're committed to making sure that we stay on that course of further improvement in the labor market, and it won't right every disadvantage that workers face, but it has resulted and will continue to result in broad-based gains for all groups in the workforce.
Time has run out, and I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from California, Mr. Royce, Chairman of the House Foreign Affairs Committee.
Thank you, Mr. Chairman. Chair Yellen, good to see you. Thank you. The latest stress test scenario that was published by the Fed includes this scenario where the rate on 3-month U.S. Treasuries drops below zero from the second quarter of 2016 through 2019. And I recognize that this in no way predicts any future action here. As a matter of fact, CCAR announced specifically in the document there that this scenario does not represent a forecast of the Federal Reserve. Nonetheless, this timing is interesting because it comes at a time when the European Central Bank and the Bank of Japan have both instituted these negative interest rate policies. So the question I was going to ask you, and let me make one other point. It may suggest that the Federal Reserve is not opposed to reducing its target rate below zero should economic conditions warrant, and may be employing the stress test process as a tool to consider its possible impacts. That strikes me as maybe the reason you deployed it in the scenario. You told the committee in November that if the economy were to deteriorate in a significant way, potentially anything, including negative interest rates, would be on the table. And so, and I remember those remarks were echoed in January by New York Fed President Bill Dudley. So, assuming for a minute that the Fed figures out this question about the legal authority, do you still believe that negative rates are a tool in the toolbox? And can we assume that the Federal Reserve would not include this scenario in a stress test if, in fact, it were not a potential future action?
Well, let me say that that was not what motivated the inclusion of this scenario in the stress test. We are in an environment where, as you pointed out, a number of the ECB, other European central banks, the Bank of Japan, have gone to negative rates. Through much of Europe, interest rates and in Japan are negative way out the yield curve. And we have had periods of market stress where we see a flight into U.S. Treasuries as a safe haven, and the scenario that we ask banks to look at is one in which Treasury bill yields go yet negative. This is something that could potentially happen without the Fed actually setting negative interest rates. It is something that could happen, and we've seen it happen for limited periods of time in stressful situations.
Well, let me ask a clarifying point, because it has been kicked around since 2010, the possibility of the Fed maybe setting negative interest rates,
I mean,
right?
So
I just quick question on looking at the Fed authority. You haven't taken a serious look at the Fed authority until now, while it was kicked around then, and you do this scenario in the interim.
So back in 2010, when we were looking for ways to consider to add accommodation, to have a toolkit available, it is something we looked at. We got only to the point of thinking that it wasn't a preferred tool. We were concerned about the impacts it would have on money markets. We were worried that it wouldn't work in our institutional environment, and we thought that zero was really the effective, or very,
I got it.
just very little was.
Let me ask you then, really quickly.
In the spirit of prudent planning, it is something that, in light of European experience, we will look at, we should look at, not because we think there's any reason to use it, but to know what could potentially be available. And it isn't just a question of legal authority. It's also a question of could the plumbing of the payment system in the United States handle it? Is our institutional structure of our money markets compatible with it? We've not determined that.
Okay, well, let me just say that I think that the central banks in Japan and Europe are trying to overcompensate for irresponsible fiscal policy. I think that's what put them in this position. Can we avoid the same mistake here in the U.S. If we get our fiscal house in order? In other words, do you agree that if we address the long-term structural problems with soaring mandatory spending, we would decrease the potential need for monetary policy actions that reversed course on interest rates?
I think it is certainly desirable and important for the long-run stability and growth of this country to take the measures that you've suggested. And evaluating the stance of fiscal policy, it is something that affects our monetary policy
Thank you,
options.
Chair Yellen. Thank you very much. Thank you, Mr.
Time of the gentleman has expired. The chair now recognizes the gentleman from Georgia, Mr. Scott.
Chair Lady Yellen, thank you for coming. Chair Lady, you know I have a lot of respect for you.
Thank you.
But I very vehemently disagree with you when you say that you can't target unemployment. Let me just say this. It is very important for everyone to know that you have an equal mission. Part of that mission, one half of it, is to curb inflation. But the other half is unemployment. And so just as surely as you go and you target inflation with movement of your interest rates, surely you've got to understand that you have the same authority to deal with the unemployment. Now, let me tell you why this is important, Ms. Ellen. Nobody is suffering from unemployment like the African American community. And they're suffering from that because of the very laissez-faire attitude that the Fed historically has dealt with just employment or unemployment altogether. But when you look, yeah, we can crow about 4.5 on unemployment rate. Do you know what the unemployment rate is for African American men between the ages of 18 and 37? It's 36.5% unemployment. And in some communities like Chicago and Baltimore, Atlanta, Houston, any of these big cities, it's hovering at 50%. Now, when you have this devastating situation, there is nobody else, there is no other agency that has the mandate to deal with it as the Fed. Now, in order to deal with it, you've got to look at the economy like it is a wheel. The economy is a wheel. And why is it that we have this high unemployment rate among African American young women and African American women in that same age group is 26%. So why is it that we can't? And a part of that reason is because the Fed has historically downplayed unemployment. Never in the history of the Fed have you even seen fit to have an African American president of a regional federal bank for the Federal Reserve. That's a part of the reason. We're not even a part of the conversation. So my whole point is that I want the Fed. Nobody is better equipped to handle this rigid unemployment facing the African American community in that most pliable age group. That is the child producing age group, 18 to 37. Can you imagine if that was the employment rate of 37.6% of white young men in that age group? All hell would be breaking loose right now to do something about it. We need that same compassion from you. When you look at the energy, the sectors of the economy that are growing, transportation, energy, agriculture business, healthcare, construction, rebuilding the infrastructure, manufacturing. We need an advocacy from you to say automatically there must be on-the-job training programs for African Americans in this hard group to go into these areas and earn as they learn. In agribusiness, we have 1890s colleges, 19 of them, whose authority and mandate through the Farm Bill is to take the money that we give them to the Farm Bill and spend in teaching, research, and extension. Why not create the other spending category for scholarships and loan forgiveness, students who will go in and take advantage of these job openings in agriculture and business? All I'm saying is that, please, we have got to get the Fed to get off the dime and put the issue of African American unemployment on the front burner. That is the core of all of the domestic issues that we're facing, and that is the childbearing group. What are these fathers to do? What is there for them? That's why we have so many of the situations in Baltimore, in Chicago, and other places, and it leads to a straight pipeline to why we got 1.2 million of them sitting in the prisons. Would you help us with that?
Congressman,
I'd love to work with you on it.
I want to assure you that we recognize how serious the problems are that you've discussed, and we take our employment mandate extremely seriously and have been doing everything that we can to promote a stronger labor market that will benefit African Americans.
Would you really consider getting an African American for the first time in history to be a regional president of a Federal Reserve Bank for the first time in history?
Absolutely. It's our job to make sure that every search for those jobs assembles a broad and diverse group of candidates, and I regret that there hasn't been an appointment of an
The time,
Thank you,
the
Mr.
time of the gentleman has expired.
Thank you, Mr. Chairman.
Would be very desirable.
The chair now recognizes the gentleman from Florida, Mr. Posey.
Thank you, Mr. Chairman. Madam Chair, the number one thing I hear from my local community banks and credit unions is the need for regulatory relief. That's not news to you, obviously, either. And these financial institutions provide critical services to our communities, and they're worried that the overregulation is hurting not only their ability to provide those services, but eventually is clearly leading to increased industry consolidation. I'd like to ask you what you consider to be the negative consequences, if any, that result from consolidation and the effects on the local and national economy.
Well, I think community banks play a vital role in supplying credit to groups of borrowers who larger banks often would not be able to serve. And that is a vital role in all communities throughout the country. So we want to see those banks thrive and are very focused on ways that we can reduce burden on those banks. I mentioned earlier some of the things that we have tried to do to reduce burden, and we will continue looking through the Agrippa process and by the regular meetings and contact that we have with community bankers to address the burdens that they face and look for ways to simplify regulation and reduce burden.
Madam Chair, do you think that relationship lending is important?
It's been very important often for community banks in the kind of business that they do, so yes.
Just a quick follow-up. Can you identify some areas of priority at the Fed for reducing regulatory burdens on community banks?
Yes, so we have been focusing, for example, on the duration of our on-site reviews and looking for ways to have our examiners spend less time on bank premises. We've been looking at ways and have simplified and tried to tailor our pre-examination requests for documentation. We've been conducting extensive training for examiners to make sure that our guidance is properly interpreted and applied in ways that are consistent. We have a number of fora in which we try to help community bankers understand what new regulations or proposals are relevant to them and which ones are not intended at all for their organizations. As I mentioned, the Agrippa process is ongoing, and we've been holding fora around the country to hear the concerns of banks with regulatory burden, and will take all of the steps that we possibly can to address the concerns that surface. We meet regularly with community bankers through an organization called CDAC, and which is composed of representatives from each of the 12 Federal Reserve districts. They come to the board, and we meet with them twice a year, the full Board of Governors, to discuss their concerns, and we follow up on what we hear.
Thank you. Finally, this week, the House is considering legislation that would require the administration to put forth a detailed plan to reduce the national debt whenever the debt limit is increased, a common sense concept, I believe. We also just received the President's budget request, which would, in the face of a 19 trillion, we just passed the 19 trillion mark in the debt clock, increase spending by 2.5 trillion. When the President took office, the national debt was roughly $10 trillion. When he leaves office, the debt is expected to have doubled to about $20 trillion. You've also voiced your concerns about the impact of failing to raise the debt limit, failing to pay our bills, citing the impact it would have on the economy. I don't disagree, but I'm curious, do you have similar concerns about the impact on the economy of failing to address our national debt? How much debt do you think is too much?
Well, I think if you look at the path that the U.S. debt is on under current policies, it will rise from the present level to levels well above 100% of GDP and continue rising more or less indefinitely. And wherever you draw the line, you've got to conclude that that's an unsustainable economic situation. So I think it's essential that Congress address this longer-run budget deficit issue.
Time of the gentleman has expired. The chair now recognizes the gentleman from Texas, Mr. Green, ranking member of the Oversight Investigation Subcommittee.
Thank you, Mr. Chairman. I thank Ms. Yellen for appearing today as well. And Mr. Chairman and Ms. Yellen, and of course, ranking member, I want you to know that there has not been some sort of conspiracy among Congressional Black Caucus members to bring up this issue of black unemployment, although I think we do talk about it among ourselves quite regularly. But I do believe that a basic premise that may be of help to us is the notion that in the beginning was the Word. And not enough talk takes place among those who have the power to influence public policy with reference to African American unemployment. To this end, I am concerned and would ask if you have in your statement given a specific reference to African American unemployment and the statement that you made today, and I apologize if I missed it, but was there a specific reference to African American unemployment?
I referenced in answer to a previous question the very high rates of unemployment of African Americans that persist even with the current aggregate unemployment.
If I may, let me share this thought with you. If it is, and I believe you are in agreement that it is a serious problem, not just a problem, but a serious problem.
I certainly agree with
If it is a serious problem, I would ask that you make it a part of your
actual statement that you present and that you publish it and that you continue to say to those of us who can make a difference, and we should be able to make the difference here in Congress. We have responsibilities here to focus as well. But if you would make it a part of your statement, and if you would publish this, I think it can have a meaningful impact on policymakers up and down the line. So just a small request, but I think it can make a really big difference. So I'm going to ask that you do this.
I'm certainly open to doing so. I'll certainly take that seriously.
Now, let's move to the Taylor rule for just a moment. You have indicated that the Taylor rule would be a grave mistake and that it would be detrimental to the economy and the American people. Could you, in about 1 minute, give some examples or an example of how it would be detrimental to the economy? That's a sort of a nebulous term, and I think you should provide some clarity.
Well, sometimes it provides recommendations for what monetary policy should be that clearly overlook important circumstances. And
if I may, Madam Chair, would you kindly explain the impact that it will have on the economy? What would the impact be if it causes us to do something inappropriate? And I'll let you decide what's inappropriate.
Well, either it would have us set a monetary policy that would result in much higher unemployment than would be desirable, or alternatively, there could be circumstances in which it would recommend an accommodative policy that would result in extremely high inflation. Now, I would say right now, as an example, the Taylor rule would recommend an overnight short-term interest rate that would be close to 2.5%. And I think in light of the slow growth in the U.S. economy and the fact that we have needed to hold the federal funds rate for almost 7 years, at zero to achieve the progress that we have made, that setting it at the level that it would now recommend would be highly damaging to the economic situation. And we've tried to provide some analysis in the monetary policy report we submitted about why that is, and in particular this idea that the neutral Fed funds rate, because of the damage from the financial crisis and
I
other
regret
factors.
that I must reclaim my time because I have one additional thing that I must say. I appreciate your commentary, and I think that a good many people have the point. But I want to say this. We have some people who are visiting today. I don't want any response from them. But I want to acknowledge their presence because they're concerned about these wages. Now, they're concerned about wages across the board, especially as they impact working people, people who are on salaries, people who make minimum wage. And it's our desire to see policies that will have greater employment, greater opportunities, but also policies that will target those who are hurt the most. I thank you, Mr. Chairman. I'll yield back.
Me. The gentleman's time has expired. The chair now recognizes the gentleman from Pennsylvania, Mr. Rothfus, for 5 minutes.
Thank you, Mr. Chairman. Welcome, Chair. I want to talk briefly about custody banks, which you know follow a different business model from other financial institutions. Custodians do not make consumer loans or engage in investment banking, and for these reasons pose relatively little credit risk. I understand that custody banks, whose customers would include, for example, pension funds with millions of beneficiaries, are finding it increasingly difficult to provide their core custody services, especially accepting large cash deposits. And this could worsen under a period of stress. One of the main reasons for this appears to be recent regulatory reforms, such as the supplementary leverage ratio, known as SLR. Custody banks typically place cash received on deposit with the Federal Reserve. This is cash that comes from pension funds, endowments, municipalities, and other clients. However, the Federal Reserve supplementary leverage ratio does not recognize the essentially riskless nature of Fed deposits or the necessity of these placements by custodians. This may cause the leading custody banks to reject customer cash deposit. My question is the Federal Reserve aware of the impact that this may be having on custody banks? And if so, what do you propose to do about it?
Well, this is something that was considered what is the appropriate treatment of central bank deposits when the supplementary leverage ratio was adopted. And a decision was made at the time that the leverage ratio is not our main capital tool, but a backup capital tool that is intended to, in a crude kind of way, base capital requirements on the overall size of a firm's balance sheet, and that for that reason it should be included. We have more recently put in place capital surcharges that apply to the 8 largest U.S. banking organizations, including 2 custody banks. And it's likely that once those are in place, that they will become the binding capital requirement. But
well, I would encourage you to take a look at that because it's an issue for the bank.
We've heard of the problem, and I will.
As you know, Chair Yellen, the Bank of Japan recently announced that it would implement a negative interest rate policy in an effort to increase spending and investment and spur growth. The decision follows close on the heels of the European Central Bank's announcement that it would also launch additional monetary stimulus in March. And economists have predicted that Sweden, Denmark, Norway, Canada, Australia, and China may follow suit. In a recent editorial in the Wall Street Journal, William Poole, the former president of the Federal Reserve Bank of St. Louis, argued that these sorts of monetary policy gimmicks will not create their intended effects, and instead they will only serve to divert attention from the actual structural problems that have plagued growth in the U.S. and around the world over the last decades, namely regulatory burdens and tax policies that serve to constrain business investment and long-term growth. What do you say in response to Mr. Poole?
Well, I agree that there are structural factors that have restrained U.S. growth and also been responsible for rising inequality in the labor market. And it's important to take steps to address those problems. They're steps that are in the domain of Congress. But it's important for the Fed to try to achieve its mandate of having, ensuring a state of the labor market where people who want to work are able to find jobs, where there are a sufficient number of them, and given the stress situations that exist in Europe where there remains very high unemployment, and in Japan where inflation has for well over a decade undershot their inflation objective. It's a tool that has proven useful to them.
I want to talk a little bit. You testified earlier over the past number of years, the Fed kept federal funds rate at exceptionally low levels. And with that, you testified that even with this, quote, exceptional, close quote, strategy, the economy achieved only 2% growth. And you added, quote, economy is being held back by headwinds. I'm wondering if any of these headwinds are man-made, or to borrow a phrase, anthropogenic here in the United States. And I could identify some. The Affordable Care Act, a Wall Street reform bill that missed the mark, frankly, EPA regulations, and these headwinds have hit folks in my district, like a mom who now has to pay $400 for allergy medicine for her kid when she used to pay $10. Or the coal miner I talked to last week who's taking care of a 5-year-old, a 3-year-old, and 1-year-old won't be able to pay for his mortgage. And I just wonder, when the economic history of this decade is written, are they going to say that the Fed tried to do with monetary policy what should have been done with fiscal policy?
Well, I think it's also important for Congress to address structural factors that are holding down growth.
Time of the gentleman has expired. The chair now recognizes the gentleman from Missouri, Mr. Cleaver, ranking member of our Housing and Insurance Subcommittee.
Thank you, Mr. Chairman. Thank you for being here, Madam Chair. Following through on some things that were said earlier, I have a bad knee, and I've had it operated on 11 times. But the weird thing is that whenever I go to the hospital for another surgery, they never operate on my shoulder or my fingers. For some strange reason, they always operate on the same knee that's been hurt. And I know that's weird. The issue is we can't address unemployment in a certain sector by saying we can operate on the whole body and it gets better. That has never been true. Now, I differ a little from my colleagues in that I don't think it's your responsibility. I don't think the Fed has a responsibility, even with the dual mandate. I think it is to be handled legislatively, and I don't think we're going to get that done. The other thing I have to say is that, and it's been said, and every time you come I have to say it because I have to just get it off my chest, because I do think that we're declaring minority unemployment too big to curtail, and that's somewhat troublesome. But the Wall Street and the big six banks, are too big to jail, and you rob a convenience store, you go to jail. You rob 300 million Americans, you get a cocktail. And I think that's what's creating all this anger around the country. I know you don't run the Justice Department, and I know you don't vote on legislation that could address some of these other issues. But I think we got to say it as much as we can because I don't think the world is hearing us. Now, I would like to yield now the remainder of my time to the ranking member of the Financial Services Committee.
Thank you very much, Mr. Cleaver. As you know, originally, I was thinking about dealing with the question of the subpoena, et cetera. Except, if you don't mind, I am so focused on all of this money that goes to these too big to fail banks and trying to understand, number one, not only the fact that, for example, Goldman Sachs got $121 million, J.P. Morgan, $910 million, and that with the rise in interest rates from 0.25% to 0.5%, this will double. And this money it's going to the big banks. It's a subsidy to keep them from lending money. And we have this big need that's being discussed by my colleagues about this high unemployment rate and the lack of creativity and thinking about how we could deal with this. And these banks, too big to fail, who we're finding every day because of the predatory lending, et cetera, are getting support from the feds. Please explain that.
It's an essential tool that we need to adjust the level of short-term interest rates. And from the standpoint of the taxpayer, our payment of those interest on reserves, we have very large reserve balances. We have $2.5 trillion roughly of reserves in the banking system as compared with 20 or 30 billion prior to the crisis. The counterpart of that on our balance sheet is that we hold a very large stock of assets on which we are earning a substantially higher rate of return than we are paying to the banks. And that differential between what we earn on our holdings of long-term treasuries and mortgage-backed securities and the 25 or 50 basis points we pay to the banks, that differential all shows up in the taxpayer's pocket. It is money that Congress can use to address all of the problems that you've discussed. Over the last year, we transferred $100 billion because of that. Now, if we don't pay interest on reserves and must use another technique to adjust short-term interest rates, likely we will be forced to greatly shrink our balance sheet in a rapid fashion, and the total amount of money going from the Federal Reserve to Congress will be significantly diminished. In addition to that, it would have very adverse effects on the economy.
Well, I want you to know that not only am I concerned, it looks like we're about to have some bipartisan concern on this issue. And while I understand the argument that you're making about the big banks, we cannot feel sorry for them in terms of the amount of interest rates, you know, that they are getting or not getting, et cetera. We really do have to deal with this issue. I understand what you're trying to explain about short-term interest rates, but if I may, Madam, let me just say this, that we have an opportunity with the discount window to allow for loans from some of these small community banks that they're not getting. And if that money went into the small community banks, they would be able to do job creation and to support small businesses, et cetera. And we just don't get why they are precluded from doing this and increasing the job opportunities in the community while we're giving this subsidy to the big banks. We just don't get it.
Although I agree with much of what the ranking member has said, she has long since spent her time. The chair now recognizes the gentle lady from Utah, Ms. Love.
Thank you, Mr. Chairman. Thank you, Chair Yellen, for being here today. Chair Yellen, I'm increasingly concerned about the impact of Dodd-Frank regulations on real economy, economic growth, and especially job creation, which I'd like to just ask you a few questions about. If you look beyond the headlines, the headline numbers from last Friday's job numbers, and include discouraged workers and the underemployment, real unemployment remains high, nearly 10%. In addition, millions of people have stopped looking for jobs. They have dropped out of the workforce, and it's a dynamic that is driving the nation's workforce participation rate to an all-time low at 62.7%. And I want you to know that I agree with my colleague on the other side of the aisle, Representative Scott, when he talks about the large number of unemployment with our young Black Americans. Meanwhile, economic growth slowed to just 0.7% in the fourth quarter. I'm concerned that the Fed and other financial regulators may not have a firm grip on the cumulative impact on the real economy of thousands of pages of the new Dodd-Frank regulations, especially new capital and liquidity rules. I'm wondering if you share some of those concerns.
Well, I recognize that some of the new concerns are burdensome and do raise banks' cost of financial intermediation. In designing those regulations, we're always trying to achieve a balance between the benefits of creating a sounder and more resilient financial system that is less likely to be subject to the kind of devastating financial crisis that we had. We're balancing that against burdens that can raise the cost of capital or diminish financial intermediation. And we have tried to strike a reasonable balance, remembering that the financial crisis, nothing resulted in more harm for a longer period of time than the financial crisis that we lived through. And I think we now have a much safer and sounder financial system.
Okay, so another study by the American Action Forum found that consumer credit availability deteriorated 12 to 14% since the passage of Dodd-Frank. I'm also concerned that the growing number of borrowers unable to access affordable bank financing, a lot of borrowers from districts, low-income areas in my district, Hearns, West Valley. These are hardworking Americans that are turning to high-cost and unregulated online lenders to be able to get the access to the credit that they need, whether it's purchasing a car or even starting a small business. They're finding that their ability to access this type of credit is unavailable to them. And so I'm wondering if you also share some of my concerns about credit availability and the higher cost alternatives.
Well, I do share your concerns about credit availability, and I think it's clear that credit availability has, in particular segments, been diminished. home loans, mortgages, for example, for individuals without pristine credit ratings is really difficult, remains difficult to obtain. In part, we have regulations that are meant to address harms. I think lending standards were too easy prior to the financial crisis. We don't want to go back to lending standards that are so loose that they lead to the kinds of predatory lending and harms that we had that took a toll on the economy and on low-income households and communities. We need to achieve a reasonable balance, and we're searching for that.
Being on the subcommittee of monetary policy, I wanted to ask you just a quick question on monetary policy and what's happening in Europe, and what are the implications? I may have stepped out of the room. I don't know if you've addressed this, but very quickly, implications of European financial instability on the American financial system. What are the implications of the Federal Reserve and the ECB pursuing divergent monetary policies?
Well, the ECB has been addressing high unemployment and inflation that slipped very meaningfully below their 2% goal by putting in place negative interest rates and large-scale asset purchase programs. The U.S. has done better. We're among advanced economies, about the strongest. So we have divergent monetary policies. It's put upward pressure on the dollar over a long period of time, which has harmed manufacturing and net exports. And so it has resulted in negative influences on a part of our economy.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Missouri, Mr. Clay, ranking member of the Financial Institutions Subcommittee.
Thank you, Mr. Chairman, and thank you for being here. The Federal Reserve has a congressional dual mandate to seek maximum employment while limiting inflation. To limit inflation, the Federal Reserve raises interest rates, which slows the economy by discouraging people from borrowing to buy homes or cars and discouraging businesses from investing. With this reduced demand, businesses will hire fewer workers, and as a result, workers will have less bargaining power, meaning they will be less likely to get pay increases. The decision to raise interest rates is based on the assessment of the Open Market Committee of the Federal Reserve about whether inflation or unemployment poses a greater threat to the American economy. Unfortunately, the members of the FOMC largely come from the financial industry, and as a result, tend to be more concerned about inflation than the population as a whole, and less concerned about unemployment. So how do we square that, Madam Chair?
So first of all, I want to say that the committee is deeply focused on unemployment. We have two objectives, not one: maximum employment and price stability, which we've interpreted as 2%, a 2% inflation objective. And I would really take issue with the idea that we are not focused on achieving our maximum employment objective. We are. And monetary policy has been highly accommodative. The Fed funds rate was at 0 for 7 years. And we also have a large balance sheet that has provided a lot of additional accommodation. So we're not talking about tightening monetary policy or a tight monetary policy. We have an economy that now has made substantial progress, creating 13 million jobs with the unemployment rate down to 4.9%. We took one small step to raise short-term interest rates, but continue to have an accommodative monetary policy, which we see as consistent with further progress in the labor market. So it's not that we're trying to reverse progress. We continue to see, even with modest increases in interest rates, further progress, and we want to achieve it precisely because we think that although the unemployment rate is at levels that are probably normal in the longer run, there remains slack in the labor market, and we want to see more progress.
Although, not to cut you off, we could get to 4% unemployment. But look, while we are pleased to see that new jobs are continuing to be created in our economy and to learn that the unemployment rate last month fell below 5% broadly, these positive signs may lead some to ignore the persistent economic challenges faced by African Americans in this country. The current unemployment rate for African Americans, for example, remains at nearly 9%. It is a commonly accepted view that access to gainful employment is one of the most important factors in supporting economic mobility and improving health outcomes. It is also widely known that in areas with higher rates of unemployment, there is a lack of consumption, increased crime rates, reduced school funding, and reduced political influence. Please discuss with us any specific actions that you have personally taken or directed your staff to take to identify solutions to help remedy the historical and continued racial disparity between employment opportunities for African Americans and whites.
So our staff produces statistics that are among the most important in documenting and highlighting disparities in the economic situations in terms of assets and income by demographic groups. And I have personally given speeches highlighting those statistics. So our staff certainly looks at and does work to document those disparities. And in our community development programs and work we discussed earlier that relates to the CRA, that's an area in which we have the capacity to try to identify particular programs that will be helpful in low and moderate income communities that suffer from special disadvantage in the labor market, and to try to identify programs that work that we encourage to be adopted on a broader scale.
The time of the gentleman has expired.
And I'd like to work more with you in that area.
The chair now recognizes the gentleman from North Carolina, Mr. Pittenger.
Thank you, Mr. Chairman. I would like to just welcome those who have come today with your T-shirts on. What recovery? Let our wages grow. Whose recovery? Very pointed and clear statements, and I really commend you for being here and seeing this process. Yes, the reality is that this recovery is the most dismal, slowest, tepid recovery we've ever had from a recession in recorded history. And we look at the realities of this recovery. This last report of new jobs was only 150,000 new jobs. We have a 2% dismal economic growth. We have the people who, frankly, the demographic group that is the lowest recovery is the low-income minority people in this country. That demographic group has moved up the ladder less than any other group, albeit an intense effort, well-intended, I'm sure, by the Obama administration, by Chair Yellen, but through it, what we've seen is very accommodative monetary policy. We've seen a high regulatory environment. We've seen Obamacare. We've seen the highest corporate tax rates in the industrialized world. All of this has achieved this dismal recovery. And I would say to you, the contrast is, back in the 70s, we had the same type of dismal economic outlook, high inflation, high unemployment. And yet what happened? We reduced the regulatory environment, we reduced the tax burden, and the economy took off. We were creating 300,000, 400,000, 500,000 jobs a month. 1 month, 1 million jobs. We were growing up to 6%. it seems to me that logic may come in, that perhaps well-intended policies have had an adverse effect, adverse outcome of what was ever intended. And Chair Yellen, I commend you for your work and what you've sought to do, but it seems to me that these accommodative policies have contributed to where we are today. I would say, Chair Yellen, I would like to thank you in your remarks that you made reference to the fact that there are those who are available to work but not actively searching for work. And you've also made reference to those who are working part-time and can't get full-time jobs. Now, these numbers are not included in the current unemployment rate of 4.9%. So in reality, we're really talking around 10, 11, 12% of the stats that I've seen of real unemployment. Would that not be correct, Chair Yellen?
Well, broader measures of unemployment are significantly higher. For example, a definition that the BLS refers to as U6 that includes both of the groups you mentioned, involuntary part-time.
Point I want to make is
discouraged
the real
is
numbers are much
9.9.
higher than 4.9%. So it's really disingenuous to say to the American people that these policies have contributed toward 4.9% unemployment. In reality, it's in the real world where people are living, and we have some of them here today, it's far less. And I think that should be understood and absorbed by these wonderful people who have come, that the types of policies that have been enacted, been enforced this last 7 years have worked against your interest. And what grew the American economy were small businesses who could go get loans. That entrepreneur who's been the lifeblood of our economy can't go to a bank today to get that new loan because of compliance requirements. They are the people who create those new jobs. And on top of that, you have the burden of obligations of Obamacare and small business. What are they doing? They're cutting jobs so they don't have to comply. What will grow your economy, what will create the jobs that you earnestly want, is an open market where companies can grow and not have this intense regulatory environment, whether it's through monetary accommodated policy or through onerous regulatory environments placed upon them. So I want to encourage you with that reality that we can find that type of opportunity economy. I would say to you, Chair Yellen, that the regulatory rule book, it's been a constant state of revision for the last 6 years. Can you see the benefit then, as a result of what we discussed, in pausing this process in order to assess the community impact of these regulations that are having on the economy before we proceed further?
Well, we have several regulations that we intend to put out during this coming year. And in terms of the list of what was mandated by Dodd-Frank, we've made substantial progress.
Consider that outcome.
nearing the end.
We're seeing today, I think it needs to be done.
Time of the gentleman has expired. The chair wishes to remind members we expect to excuse the witness as close to one as possible. The chair anticipates getting through perhaps 4 more members. The chair now recognizes the gentleman from the Super Bowl champion Denver Broncos, Mr. Perlmutter.
Thanks, Mr. Chair. And Chair Yellen, thank you as always for being here today. And I was going to go a little off topic with my first question to say, how about those Broncos? But
way to go.
The chair already beat me to the punch. But I do want to talk about the overall conversation today. And I want to thank you, and I want to thank the Federal Reserve. I want to start with the chart that we have on the board, which is really shows what happened at the end of the Bush administration when we went to 10% unemployment, and under Obama, we're down to less than half of that. Okay, so that's your chart number 2 in your monetary report. And, you know, the Republicans don't want to let the facts get in the way of their rhetoric, because then chart number 4 shows that after some time, and that's on page 5, Chair, wages are beginning to move up after we started getting people back into the job market. Chart 6, oil prices way down. Chart 7, inflation even. Chart 13, wealth to income, disposable income up, quote, a robust 3.5%. Chart 15, household debt service, way down. Chart 20, mortgage rates, down. Figure 1 on page 37, unemployment down, looking at the long term, and core price inflation, even. Those are your charts. Those are the facts. Now, have wages gone up as much as we would like to see? No, but we had to get a lot of people back working. Now we're starting to see them move. So the chair went through a whole list of economists, because obviously he didn't have a lot of questions. He wanted to list a lot of names. And there were a couple guys there with the Hoover Institute.
Quite a number.
You know, so Herbert Hoover, grand old Republican president who led us into the Great Depression. Not the kind of economy I'd like to see. All right? George Bush, we go from 5% unemployment to 10% unemployment. We lose millions of jobs. Under Barack Obama, back down to 4.9%. In Colorado, we're at 3.5%. So I just want to thank you, and I want to thank the administration for getting this economy back on track. Now, can we do better? You bet. So how would you suggest that we do better? How this economy can get moving so that the folks here can see some real growth in wages, which I think are beginning to appear. But what would you suggest?
So our objective in terms of what we can do is to try to make sure that the picture that you've put up here shows continuing improvement. In the labor market, I agree with you. I'd say the signs of wage growth increasing, they're tentative at this point. There are some hopeful signs, but I think if the labor market continues to progress, we are very hopeful we will see faster progress on wages. And we'll try to keep that progress going. That's our objective. Inflation is running under our 2% objective. I expect that will move up over time as well with appropriate policy. But I appreciate your saying that some of the burden should also be on Congress and others, because there are so many problems in the labor market and particular groups. We've talked a lot about African Americans and the problems they face. They're not. The Fed, of course, has a role to play, but job training, educational programs, programs that address other barriers in the labor market, I think this is Congress's job to address. Productivity growth is very low. I think Congress has always had a role in supporting basic research, making sure that the infrastructure of our country is adequate, and putting in place programs that make sure that training and education are widely available.
All right, let me move to a soft spot that I think exists in the economy, and you and I have talked about it before, and that's on oil and gas, and the fact that the Saudi Arabians are pumping like crazy into what appears to be an oversupplied market, causing the price to drop a lot, which in some ways is very good for all of us, because it saves us 10, 15, 20 bucks a week or a month in our price at the pump. But it also is causing some job losses in the manufacturing sectors, the oil and gas, obviously, transportation. Can you comment on what the Fed is doing or reviewing when it comes to oil and gas production?
So we're taking account, as you said, of the fact that the energy sector is very hard hit. We're losing jobs there, but with respect to employment, although there really are very severe losses, it's a pretty small sector of the workforce overall. We're seeing massive cutbacks in drilling activity, and that's rippling through to manufacturing generally, where output is depressed. So it is having negative consequences. On the other hand, if you look at the difference in oil prices now relative to 2014, For the average American household, we're looking at a savings of $1,000 a year, and that's boosting consumer spending. And we've got these two, a negative force, positive forces. We're trying to factor all of that in as
The time of the gentleman has expired. The chair now recognizes the gentleman from Illinois, Mr. Hultgren.
Thank you, Mr. Chairman. Thank you, Chair Yellen, so much for being with us today. As you may know, the Financial Crimes Enforcement Network, or FinCEN, is in the process of finalizing some new requirements to prevent terrorism financing and money laundering under its beneficial ownership rules. While I fully support efforts to curb terrorism financing, it seems the application of FinCEN's rule to certain non-bank subsidiaries, such as premium finance companies, may not be appropriate. I understand that my staff is already talking with the Fed about this issue, but wondered if I could get a commitment from you today about trying to find clarification for if these rules apply to premium finance companies that are subsidiaries of banks.
I'm sure we're happy to work with you on that.
Thank you so much. When you testified before the committee back in November 4th of 2015, we discussed the impact of the supplementary leverage ratio on custody banks. At that time, you described it as a kind of backup ratio that works as a backup to risk-based capital standards. When responding to questions from Congressman Rothfus earlier today, you stated that when the supplementary leverage ratio becomes effective, that it will likely become the binding capital requirement for some custody banks. I understand some of these custody banks already feel they must discourage customer cash deposits. As you know, these institutions have highly liquid, low-risk balance sheets that support client needs. In light of this concern, will the Fed consider adjusting the capital requirements for excess cash deposits held with the Federal Reserve?
So I'm not sure if they will become if the supplementary leverage ratio will become the binding constraint or not. I didn't intend to say that it is the binding constraint. There will also be so-called SIFI capital surcharges that will come into effect that may make those the binding constraint. I mean, this is a matter that I understand what the issue is. We can look at it and discuss it. It was debated at the time. There were considerations on both sides, and a decision was made to include Fed deposits. It's something we can look at, but it was considered.
Well, I hope we are able to discuss that and also look and see if it's necessary for us to have congressional intervention as far as legislation to change the rule. Let me move on. I'm pleased by the news that the Federal Reserve has been engaged with the insurance industry on capital rules appropriate for the business of insurance. What are your thoughts on how that process is proceeding, and when might we expect to see proposed rules from the Federal Reserve released for public comment?
We're working very hard on that. I don't have an exact timetable, but we are expecting to go out with, for each of the firms, a notice of proposed rulemaking so the public can react to these rules. The staff is fairly far along in developing these, so my hope is that it won't be too much longer. We've worked hard to have the appropriate interactions with the firms and other regulators to do this right.
Well, I appreciate your work on that. From Illinois, insurance is important. We've got some wonderful companies there, but I know they've got questions, and I appreciate the interaction and hopefully resolution relatively quickly. One last question. Will the Federal Reserve issue one proposed capital rule for all insurers it supervises? And if you could explain why or why not.
I'm not positive. I think for the particular SIFIs that have been designated Prudential AIG and MetLife, there are likely to be firm-specific rules, but I'm not positive. Let me get back to
That'd be great.
on
Thank
that.
you. Thanks, Chair Yellen. Mr. Chairman, I have an additional minute. I'd yield that back to the chairman if the chairman would want that. Otherwise, I yield back.
Gentleman yields back. The chair now recognizes the gentleman from Minnesota, Mr. Ellison.
Thank you, Mr. Chair and the ranking member. As we start out, I also want to thank some of the folks who've joined us for the hearing today. A good friend, Ron Harris, is here from Minneapolis. Good to see you, Ron. And I just want to let you know that this active citizenship of coming to these hearings, watching things, is exactly what is needed in order for this government to function properly. In my view, this is what democracy looks like. Thank you all for being here. Now, let me, Ms. Yellen, Chairman Yellen, let me point your attention to the words of Mr. Narayana Kocherlakota, who is a former Minneapolis Fed chair, outgoing president of the Federal Reserve Bank of Minneapolis. He made on Martin Luther King Day, he wrote a blog, and here's what he said in part. There is one key source of economic difference in American life that is likely underemphasized in the FOMC deliberations: race. He went on to say for the year, he went on to say that he searched through the transcripts of the FOMC meetings for the year 2010, his first year on the committee, and a dire year for African Americans in our labor market. And in that year, a total unemployment rate exceeded 9.25% every quarter, but for African Americans, it exceeded 15.5%. Today, now, white unemployment in Minnesota is 2.9% as of December 2015, but black unemployment is 14.1%. And in Minneapolis, white unemployment is 4%, but overall, white unemployment is 4%, but black unemployment is a shocking 18.9%. So I say that because, this is something that I think needs the attention of the chair. And you may, I don't know what constraints you believe are out there, but, race matters when it comes to how people experience our economy. And if we don't discuss it, talk about it, and then we won't ever get to the heart of the matter as to how to fix it to make equal justice for all. And so I guess my question, and I'll quote Coach Lakota one more time. He said, as we all know too well, race matters. The average African American's experience with the U.S. economy is different from that of the average white person's. So my question is, what do you make of the commentary from the previous Minneapolis Fed president? In your view, is there adequate discussion, attention of the economic situation of African American workers within FOMC deliberations? And if so, and if there's not, and I suspect you'll say there's not, what can we do about it? How can we at least focus the committee's attention on this segment of our fellow Americans?
So it's of course important that we look at different groups, and particularly those who are suffering the most in the labor market. And I'm surprised that there was no specific mention of race. It's in 2010, the unemployment rate was substantially higher than it was. The committee was very focused at the time on what we could do to promote a stronger labor market. And I suppose because our tools are not ones that can be targeted at particular groups in the labor market, it was clear what we needed to do, and that was to support a stronger labor market more generally.
But Chair Yellen, forgive me for the interruption. I definitely think that I get that part, but I'd rather talk prospectively, because the past is what happened and there's no change in it. How can the Fed chair get the FOMC to say, wait a minute, not all Americans, particularly African Americans, are experiencing this upsurge in economic activity? For Black Americans, we're still in the midst of a very serious depression, recession. What can we do about it? And I'm not here to say to wag my finger about what happened. We know what happened, and it wasn't right. But in terms of what's happening now and what can happen, what can you tell me?
Well, I think you're right that we should pay adequate attention to how different groups are faring in the labor market. We've made clear that we don't focus on any single statistic, that the unemployment rate is only one measure of what's happening in the labor market, and it is appropriate for us to really try to do a much more detailed assessment of where things stand and what we should be aiming for.
Time of the gentleman has expired. The chair anticipates calling upon two more members, Mr. Barr and Mr. Delaney, and then excusing the witness. The chair now recognizes the gentleman from Kentucky, Mr. Barr.
Thank you, Mr. Chairman. And Chair Yellen, thanks for being back before us. The last time you were here, we talked about a qualified CLO concept, and you were kind enough to respond to that question in writing, and I want to thank you for that, and I want to particularly thank you for recognizing that the qualified CLO concept could be considered a positive development in the market. And I'd like to continue our discussion about the role that regulation could very well play in terms of being a source of economic instability, particularly in our capital markets. The Basel Committee recently finished a rule in January that increases the capital held against securitization exposures in a bank trading book by up to 5 times the amount already required under Basel III, as well as the final TLAC rules. One industry study suggests that trading in U.S. asset-backed securities will become uneconomical if the rule is not tailored to fit the U.S. marketplace. If it is uneconomical to act as a market maker for commercial mortgage-backed securities or residential mortgage-backed securities, auto loans, credit cards, collateralized loan obligations, then banks will pull out of the ABS market, which represents a $1.6 billion source of consumer lending, or 30% of all lending to U.S. consumers. So my question to you, Chair Yellen, is how will the Fed ensure that the final rule will be tailored to fit the U.S. market, which is the most liquid ABS market in the entire world?
So I will have a careful look at that. I'm not familiar with all of the details of the Basel proposal, but anything we implement in the United States, there's nothing automatic that is implemented in the United States, and we will have a careful look at what the impact would be.
Well, I appreciate you doing that, and I continue to urge the Fed, and you in particular as a member of FSOC, to look at government regulation as a source of economic instability. To that end, we are told by many of the regulated bank holding companies that there's no updated organizational chart within the Fed. And so my question would be, can you share with us, or can your staff share with us, a detailed organizational chart with the names and titles of the Bank Supervision and Regulation Division's full professional staff?
I think so.
The organizational, as I'm told, that whatever organizational chart you have is very dated. And
Yeah,
so we can't even get, many of the folks can't even ask you questions.
I don't see any reason we can't.
I appreciate you doing that. Switching gears really quickly to the Consumer Financial Protection Bureau and their funding source, which, as you know, according to the budget overview that the Bureau makes public, transfers from the Federal Reserve System are capped at $618 million for FY15, and the transfer cap is estimated to be $631 million for FY16. Given that my time is scarce, if you could just answer the following in yes or no responses, that would be greatly appreciated. Does the Fed approve the Bureau's budget?
I'm not, I mean, we fund the bureaus.
You fund it, but do you approve the budget?
I don't think,
No.
I think the answer is no, but.
Right. Can you veto specific allocations requested? No.
I don't think so.
Okay, and does the Fed have protocols if the Bureau seeks to transfer more than the cap on its transfers under the formula? Do you have a protocol in place to prevent that?
I mean, we abide by the law. I need to look at the details of what our obligations and limits are. I need to look at that more fully.
We'd
But
like to know
we certainly
if
have protocols to abide by what Congress set out.
Well, see, this is the problem that we have, is that we don't have appropriations control over the Bureau. And so they get their funding from you. We would hope that they would at least be accountable to you as the funding source. Is there any direct oversight of the implementation of the Bureau's budget by the Fed?
No, our Inspector General has authority both for the Fed and the Bureau, but the Fed does not have authority over the budget and spending of the
Thank you.
CFPB.
Thank you. In my last 10 seconds, you've talked a little bit about the need for Congress to address our long-term debt and deficit crisis. This seems to me a five-alarm fire. Why isn't the Fed, given that mandatory spending is 70% of the federal budget, why isn't the Fed more aggressively warning Congress that it must reform mandatory entitlement spending?
Every Fed chair that I can remember has come and told Congress that this is a looming problem with serious economic consequences. I know my predecessor has. I have on many occasions. I certainly remember that Chairman Greenspan discussed with Congress the importance of addressing this.
Thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from Maryland, Mr. Delaney.
Thank you, Mr. Chairman. And I want to thank you, Chair Yellen, for not only your leadership in general, but also your participation and patience at this hearing. I also want to welcome our visitors and guests here today, and thank you for bringing your important message. We do talk about how our unemployment rate has gone down substantially, which it has, below 5% now. But we all know that when you get behind those numbers, there's really only two types of jobs being created right now in this country: high-skilled, high-paid jobs. We need very, very specific skills, advanced educations to get those things, and low-skilled, low-paid jobs. And what we're not creating is middle-skilled, middle-class jobs, the kind of jobs that have been the backbone of this country for a long time and allowed wages to grow and people to raise their families with one job. And the chair touched on something very important, which is infrastructure, because there's nothing we can do as a country to help address that problem more than rebuilding our country. So if I could ever edit your T-shirts, I would say, let our wages grow, comma, rebuild our country, because I do think it would really make a difference in raising wages. But my question for the chair, and again, thank you for your patience. In December, when the decision was made to raise the federal fund rates, in your testimony you said that was in part based on a view that economic activity would continue to expand at a moderate pace and labor market indicators would continue to strengthen. And certainly, based on the top-line data from 2015 and 2014, where we saw decent GDP growth, improvement in the residential market, business investments at a decent level, not where we'd like them, but at a decent level, increases in R&D investments, et cetera, that even when you take into consideration the negatives from the oil and gas sector, the outlook for economic growth was reasonably solid. And the labor market data that you were looking at the time must have been good, because the January numbers were actually encouraging, not only in terms of unemployment, but some of the wage data, as you talked about. So I guess my question is, a lot's happened since that decision in the markets, and that tends to change behavior. When you look at the same data you looked at when you made that decision in December, if you look at that data now, does it change your view as to your perspective on economic activity, economic growth, and general labor market trends?
So I think the answer is maybe, but the jury is out. We've continued to see progress in the labor market. Over the last 3 months, there have been 230,000 jobs per month averaging through. GDP growth clearly slowed a lot in the fourth quarter. My expectation is that it will pick up this quarter. But on the other hand, financial conditions have tightened considerably, and that can have implications for the outlook. And what the committee said in January, we had previously said that we regarded the risks to the outlook for economic activity and the labor market as balanced. Right. What we said in January is that we're evaluating and assessing the impact of these developments on the outlook for both the labor market and activity, for inflation, and the balance of risks. And that's what we're doing at this point.
And when you look, Chair Yellen, at recent data that you get better than anyone about credit formation and borrowing activities in the markets, are you concerned that there's been a significant contraction in credit availability based on recent market activities? And how much does that factor into your...
Well, that is an important factor.
And have you seen it?
Well, not really at this stage, but what we do see is that spreads, especially on lower graded bonds, have widened considerably. Borrowing rates have widened.
What about bank lending?
And it's not just energy. In our most recent survey of banks on their lending standards, we've seen a tightening that's reported in C&I loans and CRE loans, and that certainly those loans continue to grow, but that is something that bears watching. And it's really those kinds of trends that we need to evaluate what are
very
their
quickly, as you
implications.
weigh your decisions, obviously inflation and labor market participation are critical. Overall view of economic activity is critical. This subcomponent, in other words, what's happening with credit availability, how important is that in your decision-making process?
What we're trying to do is forecast spending in the economy. Investment spending and housing are two important forms of spending, and credit availability factors in to our forecast for both of those portions of the economy. They're not the only factors that matter, but they are a factor that is important, and so we will be considering those. And there's a number of weeks before we meet again in March. There's quite a bit of additional data we'll want to look at, but you've pinpointed exactly the kinds of considerations that will bear on our thinking.
Thank you again.
Time of the gentleman has expired. The ranking member is recognized for unanimous consent request.
Unanimous consent to insert into the record a statement from Financial Innovation Now that would like to highlight the very important work the Fed Reserve Board is doing through the Faster Payments Task Force, of which Ben is a member.
Without objection, I thank Chair Yellen. I thank you for your testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witness to the chair, which will be forwarded to the witness for her response. I ask Chair Yellen that you please respond promptly. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing stands adjourned.